Welcome to the Business Brew. I'm your host, Bill Brewster, with my esteemed guest, Tobias Carlisle, this week, aka Greenbacked. As a reminder, none of this is investment advice. This is the opinions of the two of us. Get your own advisor. We are not your fiduciary, but thanks for joining us along this road. Toby, how you doing?
Hey, Bill. Good. Happy to be here. Happy to be chatting to you.
Yeah, we never do this. We're never on a podcast together, so it's real weird, right?
it's a new opportunity.
Yeah. Well, a little different format this time. Now I get to interview you. You interviewed me a while ago, and now I get to hear all of the thoughts of the man that is known as Greenbacked.
Is it an interview or is it a conversation? We're having a podcast style conversation.
Yeah, I guess.
We're going for the Rogan, right? We're going for the Rogan back and forth, where we're both just like ill-informed and just like say whatever the fuck we want.
It could definitely become that for sure. I guess that I like to think of them as interviews now that I control the conversation a little bit. I'm not on your platform for a change.
Scary, man.
It is a little
scary. To make me sound like an asshole.
No. We'll keep you like you are. You may do a good job sounding like that on your own.
Yeah, I can do that all by myself.
So, man, I guess that a lot of people that I have talked to over the past week don't know how you became the face of value. I have listened to you on the Matt Cochran podcast, that 7 Investing one. I think you did a pretty good job. But why don't you take people through how you got to where you're at?
Yeah, I don't know exactly how I became a guy. I think value has worked so badly for so long that I've become like the last man standing who's even prepared to call himself a value guy. Because I say that to people now, they're like, oh, I'm not a value investor. I'm not. I want to make that very clear from the outset. I'm just an investor.
Yeah.
And all intelligent investing is value invest. Like they kind of go through that whole thing where they're like, don't tag me with value because I don't want that anywhere near me.
Then I can't raise funds.
Then I can't raise any money. Yeah. Have a look at my track record. So I've just been kind of unapologetically value, but to be honest, like I don't think that I'm doing anything that is that different from almost everybody else. The only thing that I really do, I think, is that I have been more prepared to buy garbage businesses, but that hasn't worked out that well either. Historically, that hasn't been such a bad thing to do, but it's been a bad trade for probably 5. It really stopped working in 2018. Like the beginning of 2000, it was working fine. It was cruising until like end of 2017. Like there were bad years and good years. 2013 was a spectacular year. 2015 was a disaster. 2016 was a pretty good year. 2017 was like okay, and then 2018 was just garbage, like just going backwards when the market was going up. Then again last year and again this year. So it's been 3. For my style, which is, I care less about really the quality of the business. I just want the balance sheet to be healthy, to have a business that has been functioning. Doesn't have to be a great business, like doesn't have to be growing and compounding. It just has to be, not going backwards really. But even then I don't mind. If it's cheap enough, it doesn't really bother me. But that's been a bad trade for 3 years. So I think, by virtue of the fact that I wanted to own some of that headspace because I wrote a book called Deep Value. So I was like trying to get that, I wanted to be that guy. And then I probably top ticked Deep Value. That came out like 2014. It's all sort of bumped sideways then. I honestly don't know why. I think that probably just overvaluation in value and that spread being very tight, which Jake Taylor, our co-host on the other one, he pointed that out in 2015 in real time. He was like, this is the worst opportunity set for value in 25 years. And I've said this a number of times, but I should have learned that lesson then when he said that, which was, value I think is quite cyclical. This is the thing that, I'll say this to guys and I'll say, no, value's evergreen. Value's always going to work. And the idea, right, that you're buying something for less than it's worth, that's evergreen. There's no question about that. But within that spectrum of values, there you can find value with undervalued assets. You can find value with compounding businesses. But not all of those types of value work all the time at every stage in the cycle. The undervalued asset stuff, probably does work better out of a rebound. And the compound stuff tends to work better at the end of the cycle, just because the multiples tend to stretch a little bit at that point. So I sort of found myself in the deeper value end of that, which hasn't participated as much over the last 3 years. I don't really want to change because I do think that it's cyclical and I think it comes back. And I think that you get better returns being deeper value. I mean, if you believe in the idea that you're buying, the less you pay for something, the better you're going to do, which is just, that's got to be like, as a statement of logic, that's got to be true. How you define the value, like that's open for debate, right? But as a statement of logic, that's true. If something's worth 30 and you pay 10 for it, you're going to do better than the guy who paid 20 for it.
Yeah.
So deep value is hunting around in those really beaten up things and trying to find the things that are worth 30 and trading at 10. But I think that that idea is always going to work, but there are going to be periods in the market where it doesn't. Clearly it doesn't. It's a little bit more cyclical than I realized. So I think at the moment, I think the deep value bet is a pretty good one here. But as the cycle matures, this next cycle that we go through, and I don't think that this one's necessarily over yet either. I still think you and I can have a pretty solid argument about what innings we're in here, but I think that we're closer to the tail end of one than we are at the beginning of another, but we can get into that, I suppose.
So I was looking, I mean, you mentioned that you're not, or that you're willing to buy lower quality businesses. But when I look at what you're holding, I would say that the growth aspect is questionable, but the actual business quality is quite a bit better than maybe I would perceive in a deep value strategy.
Yeah, I do say that a little bit. I should be careful how I frame up what I talk about when I talk about what I'm trying to do. I think that one of the great traps, what has historically been a great trap, is paying up for growth. And so I try to get as much. I want balance sheet. I want like a bulletproof balance sheet, an impregnable balance sheet, like net cash on the balance sheet, ideally, and then a business that is throwing off cash at least, not necessarily growing. I mean, you can look at lots of businesses out there. Like eBay is a good example. You have a look at eBay. eBay is a very, very solid business that throws off an enormous amount of cash. But if you look at how much they're paying out, like they're clearly liquidating. They earned like $4 billion in free cash flow this year. They've paid out like $7 billion. And they've got a very small capital base. Like if you do that Greenblatt return on capital type measure, like it's massive because they've got, hardly anything in PP&E, hardly anything in net working capital. They've paid out like 90% of their working capital. I mean, of that excess capital this year. They can't do that for very long because I can't remember the number exactly, but they've got that if they do it for one more year, they're basically going to have negative capital in that business. So they're not going to do this one more time. Like that's the last time you're going to get this kind of flow out of it, I think. But the business isn't going to shrink down much, I don't think, from this. It's not like they need the capital, the assets in there to grow the business. So eBay, I think, is a pretty classic example where, it's old tech, that the website's pretty janky. Nobody really goes there anymore. It's like you can get other markets that you can go into, although it's still earning heaps and heaps of money. It's still growing, not super fast. But that's the kind of business that I like. Like another one is Value Line.
Yeah.
I mean, I don't own Value Line in anything. I should be careful about saying this, but I don't hold it. I do hold eBay. I don't hold Value Line. But Value Line is one that I would buy if I had the opportunity. Value Line similarly, like basically doesn't grow, but it takes no assets to run that business. And if you have a look at it, like even though the top line itself doesn't grow, the underlying value of the business has grown pretty dramatically over the last 4 or 5 years. But to look at it, you wouldn't know that. It doesn't look like it's done anything particularly special. So that's the kind of stuff that I'm looking at where it's like, I love the word crypto for secret, but it's like crypto growth. It's like the top line is doing nothing, but the bottom line is kind of like the bottom line, and on a per share basis, the value is exploding. And people just don't realize because they're looking at the top line, trying to find the growth there. Now there's, I remember when I wrote concentrated investing, and we interviewed Glenn Greenberg. He was Brave Warrior, and now he's Chieftain. And the reason that they separated was because he wanted to buy higher growth businesses, and his business partners wanted to buy, more of my style, deeper value stuff. Now he's been, I think, he's had the better performance since that time. And they have struggled a little bit. But as I was reading at the time, I was like, it shouldn't make any difference to you where you get your growth. Like, I don't care whether it's top line or bottom line. But evidently that it has made a difference over the last 4 or 5 years. Like, I think some of that bottom line growth has kind of been ignored for only the top line growth. And I don't know why the market does these things, but I think sometimes you got to kind of move to where the market's not. So when the market is ignoring the bottom line growth, then that's where you want to focus. That's where you're going to get the better value. The market did this in 2015. Clearly it wasn't valuing those FANG stocks properly in 2015. It wasn't, when you looked in the Microsoft's the company, when you looked in the Morningstar style box, they were all, the PEs across small, large, growth and value were all identical, and that's clearly not right. Like, you should be paying more for growth.
Yeah. But, assuming it's economic, right?
Assuming it's economic. But as a general rule across the entire, those style boxes, you probably should be paying more. For the cohort, you should be paying more for growth. And they won't be, that nobody was paying up for growth in that instance. So that was a good opportunity to go and buy cheap growth. I don't know what the solution is. I think that probably, one of what Buffett, I think, is trying to do is to appropriately value the growth, which is tough to do. And I think it's a trap for a lot of people to fall into. But I do think there are clearly guys out there who can do it. And I think that I think it's achievable. So I'm going to try and sort of do that a little bit more in the future. But I think that the opportunity right now, I think my style will change a little bit as we go through this, but I still think the opportunity right now is in deep value. I still think it's right where we are, right where I am anyway.
The idea of valuing growth right now and figuring out who's good at it, I find to be very difficult because...
Which investors?
Yeah, that's right.
Yeah.
Like, because there are some people that are right for the right reasons, and then there's others that are just sort of like tagging along for the ride. And, everybody that writes a letter is smart. I mean, like, if you're in the game and you're able to even have like any assets under management, it means that somebody trusted you, right? If it's outside money. So, I mean, the probability that you're worth reading and have, like, everybody's some measure of intelligent, and separating who's lucky from who's good right now, I find to be quite difficult. And, I mean, we know a lot of these guys, right? So,
but you can talk to people, right? And you can figure out, like, what's your process? If your process is the top line's just exploding, then I think you're probably going to run into a wall at some stage. If your process is they're adding this many subs, even taking a conservative approach, at some stage it gets over its fixed costs pretty substantially, and then like the subs are growing at this rate, you can forecast out, rather than just like a naive DCF where you're just growing the top line. You're actually like working out what the drivers of the return are, forecasting that out. Like, I think those guys are going to keep on doing really well, whatever they might. I think they might find it. They might walk into an air pocket here and not understand why they're in an air pocket, even though they're doing all the same things. I think that's going to happen to a few people. But the same thing happened, because that's kind of what happened to deep value. Like, you could be naively buying low multiple businesses and doing quite well, but you had to kind of transition through this period. You needed to be working out what the drivers of that value were and how you were going to catalyze that value. And and then I think that value probably got appropriately punished for a lot of people between 2015 and 2018. I think it's been unfairly punished since about 2018. But we'll see. I sort of think that the deeper value will have a pretty good turn here at some point, just because I think it's so compressed. I think you're seeing some of it now in the small and micro is just kind of exploding. Like, just, you don't need to be a value guy in small and micro at the moment. It's just exploding. You just need to be in small and micro.
What, I mean, do you think that like, first of all, I fanboyed out over you when we met at that Berkshire meeting. The reason that I wanted to go like meet you was the book Deep Value. When I read that, I was like, oh man, this is like the best book ever. Do you and I still believe that. I think everyone should read that book. But do you think that like writing that book at that time maybe precluded you from seeing what the opportunity in growth was?
Yes, 100%.
Yeah.
It was right at the top of the cycle for that.
Yeah.
And I think that probably it flattered some of the results because I was getting,
Huh.
like, this is one of the things that, like, if you think about the way that you do a back test, something that has like, so if you do a back test right now, you see the growth stuff is like massively outperformed value. I'm
Yep.
not even talking about like growthy value. I'm just talking like pure growth is massively outperformed. And it would, like, I think that it's now outperformed over the last 30 years. If you were just to do a naive back test on that, you'd say, well, shit, why would you ever be a value investor?
Yeah.
Growth is clearly the place to be. But really, a lot of that return, the bulk of that return, and like it can be like 60%, like it's outperforming by 60%, which sounds like an astronomically large amount compounded over 30 years. It feels like there's no way the value can ever catch up. But I've done back tests that, the back tests that ran to 2014 were the other way around.
Huh.
They were
Yeah, because
flattering
that's what
value
I've
of them.
been worried. Like, I mean, I just said worried. It is what I've been a little bit worried for you. Like as a friend, it's like when you fall, like when value gets this far behind, how does it catch up? And I mean, the answer is the alligator jaws can close,
That's
right?
it.
But you're making a pretty contrarian and pretty concentrated bet. As someone that roots for you, it's a little bit scary to be perfectly candid.
It's almost like, I agree. This is almost a macro bet.
Yeah.
It's almost a macro bet on value rather than typical value, which is like, even though the process inside it is internally bottoms up valuation of individual equities to arrive at valuation, but I could clearly be doing different types of valuation on these things. I could be like thinking about the growth more. I think I honestly do think that over the very long run, deep value will be the better returning strategy. And I think that from this point over the near term, like over the next 5 years or 10 years, it's the better returning strategy. Having said that, I would also like to add a sort of a more discretionary private equity style investment approach. Just for one thing, it's more fun. Like I have a conversation every week with one smart value investor on my other podcast, and then you and Jake and I talk, and I have lots of incoming through Twitter. Like I just have there are so many phenomenal ideas out there that I just can't, like, I can't justify it through my existing vehicle because they just don't meet those criteria. But I can see that these things are, with like conservative assumptions on growth and various other things like that, like they are going to be just absolute blockbuster investments. They've got the right kind of managers, the right kind of business. The business is built in the right kind of way to grow very rapidly or to make some sort of step change. Like I think Twitter's a classic example of that.
Yeah.
Twitter is going to have this big step change sometime this year or
It's
next
hard
year.
to
Sorry,
think it's
this year.
not, right? I mean, obviously, people are going to say, well, it's super mismanaged. I mean, that is the bear case against it. But like, if you believe in eyeballs driving mindshare and smart minds driving economics, it's pretty hard to see. Like, the only reason I am anything, which is admittedly a very small gnat in the world, but is because of Twitter. It's all built on that,
Right.
and it's all free. That makes no sense.
Here's the thing about Twitter, right? It's been run by a part-time CEO, and everybody knows the initial story about Zuckerberg saying it's like the clown car that fell into a gold mine.
Yeah.
But the thing about Twitter, like, Facebook was super hot for a while because it was exclusive. You needed to go to it, maybe an Ivy to get into it, and then they sort of opened it up. That was really clever.
Yeah, that was really smart.
And then it kind of got, the cohort that was using it got a little bit older, and the kids didn't want to be on that same platform as the old. So they had their own platform, which was Instagram. Now, Instagram's grown up. Instagram's probably the leading platform at the moment, but the kids don't want to be on Instagram because that's where all their older brothers and sisters and parents are. So they've migrated to TikTok. Same thing's going to happen to TikTok. Twitter has never participated in anything like that. Twitter's never been cool. Twitter can't become uncool. Twitter's super hard to use the first time you go on. You send a tweet, it just goes out into the ether. Nobody
Yeah.
responds to it. You're just like, what is this? It takes a while to kind of like even figure out what it is that you're doing there,
Yeah.
which makes it hard to get into. But once you're in there and you realize that the power of it is, it's like the best news service you've ever seen. Like, it's crazy how early something, you'll see, like someone will get a police scanner and retweet the police. Like, there's someone has got a Twitter account that transcribes a police scanner. And then there's somebody who follows that Twitter account and says something big will happen, and they'll retweet it. So you see, like, seconds after it goes out on a police scanner, 4 hours later it comes up on CNN.
Yeah.
You know, like the lag is just so huge. It's hilarious how much it's moved on. So it's the best news source for just like unfiltered news, or it was. I don't know if we have to see how this all goes. But then you've also got the best opinion and analysis. Like, if I want to know what some smart value investor thinks about some of the news that just happened, like, they're literally just right there to ask, or they're already talking about it. So it's phenomenal from that perspective. And then it's also a good marketing tool for me. It's a great marketing tool for like getting people to come into to my business. So I can see the power of the product. The business behind it has just been so shithouse for so long. You kind of think, how can they ever
It
just
really
stop?
is.
They're just stepping on their dicks all the time. Like, it's kind of amazing. Yeah, you would
It
think
makes
to
no
yourself,
sense.
as a non-tech, non-kind of marketing guy, like, I could figure some of this stuff out. And that just, they haven't done it because they got a part-time CEO, and they just don't seem to be focused on the right stuff. But then Elliot shows up.
Yeah.
You know, got to be the toughest hedge fund out there. You know, Elliot, who takes control of South American nations' oil
Argentina
ships.
ships. That was a serious move.
That's like high seas piracy if you get that one wrong. You got to be careful there.
Yeah.
It's jail time if you get that wrong. And it's a nation state. Like, you don't mess around with nation sovereigns. You got to be careful of. But
what
they
do you
did
think
that.
they were thinking when they did that? Like, that takes such balls to be like, even if somebody in the firm like pitches, well, we could take this ship that they love. Like, who's the? I mean, I know who the guy is, but like, what's Paul Singer
You're
thinking
first
when
in the
he's
door.
like, yes, we're doing that, and who are we going to hire to do it? Like, what a monster!
I mean, it's kind of like it's like supervillain type stuff.
Yeah.
It's crazy. Like, it's the ballsiest move. I've never heard of anything like it. There was a book around in like the early 2000s about these activist investors taking control of a South American country's debt and then like taking over the country through the debt. Like, it was just as a gag. So this is like about as close as you could get to that without, having a coup. There was like literally, anybody who's read that book about the term banana republic came from I think it's the fish that ate the whale or something like that. The term banana republic came from the banana companies used to topple these democratically elected presidents, topple these democratic governments so they could sell their bananas. And Vanderbilt did exactly the same thing. Like, to get his Panama Canal built, they used to send guys down who would overthrow the government. That was their job. They had a great name too. It's just escaping me right now. But I read there's a biography of Vanderbilt that I read. Just like, because he wanted to build, so to get from New York, so like steamships come in about 1815, 1825, something like that, at the beginning of the Industrial Revolution in the States. To get from New York to San Francisco, you had to sail around the bottom of the Cape of Good Hope, Cape Horn? What's the bottom? Whatever the bottom of the America, like the South American continent. Like, that's how you got there. It was a super, super long trip. But clearly there's this little, you could go through the canal, the Panamanian Canal, but there was a whole lot that had to be over land. It was treacherous. Like, you could die going that way too. Or you couldn't go through the middle of America because you'd just be killed by the Indians in the middle of America. So like, there was just no way to get there. So it was clearly very important for them to get this done. So they dig the hole through the middle, but like, they weren't going to let some government stand in their way. They just sent some of their men down to like overthrow the governments.
I don't think I'd be very good at that game. This guy's too big of a pacifist.
That's way too hardcore.
Yeah.
There's easier ways.
Fortunate to be in a room when somebody that's knowledgeable was talking about like who is the scariest activist that you've ever met. Like this person has interviewed a lot of them, and they've said by far Paul Singer. Like
Oh yeah,
there's not, it's not even close, right? And like she's talking about the beasts of the game.
icon.
Yeah,
Got to be Singer though.
yeah. I just think, I mean, you look at how they go about their business. I wouldn't want to be on the other side of it.
But this is the thing that this is something I think about a lot. The problem for investors, like basically the only problem for investors is this. It's a principal agent problem, right? Which they teach you very early on in law school or in business school. The idea is like, how do you get the agent who's the CEO of the company or the management of the company, the board of the company, the board of the company, to behave in the best interest of the principal, who's the shareholders. Now, if you solve that problem, you get a step change in value, which is why activism is such a powerful approach. Like you marry activism to deep value, all of a sudden you're getting these blockbuster returns pretty consistently, regardless of which direction the market goes in. And I've been a fan of that style for a very long time until basically more recently. And I've been thinking more about what Buffett does. And I know it's boring for people to keep on going back to Buffett all the time because he's so high profile and he's been out there. But for me personally, like it's been the more time I spend investing, the better I understand the investment process and investing. The better I realize that Buffett is, like how smart he is, how strategic he is, how perfectly well built he is for the thing that he does. And I know that like his reputation is like he's like a cuddly grandpa, but he's kind of like,
that's his reputation among people that have no idea.
But he's cultivated that a little bit too, right?
Oh, for sure.
Knows
that's his
to his
marketing
advantage. So I've been talking to you guys about this a little bit, and this is the book that I'm currently writing right now. I went and looked at. So I've tried to read Sun Tzu's Art of War like half a dozen times, and it's impenetrable. I've read, I don't know how many translations there are. There are at least 7 translations, and I've read 4 of them now. And each one is like, there's a lot of similarities. There's also a lot of differences because he's writing in ancient Chinese, which then has to be interpreted by, and there are translations that are 100 years old where they're translating into an English that doesn't really make a lot of sense now, even 100 year old, whatever they are, a couple of 100 years old. So when you find these, even like I've got the Thomas Cleary edition, which came out in 1988, and there's another free edition online, and the MIT edition, which is sort of an older translation. They're very, very hard to understand, and it looks like when you're reading through a lot of it, it's sort of, is it allegorical because it's a translation? Do you miss some of the allegory in the translation, or was he never trying to be allegorical at all? He was like literally just saying, "This is what you should do." When you find yourself fighting on marshy land, get your back up against the trees. Well, that's awesome, man. That's really helpful. Like I can think of 10 applications for that in my day-to-day life.
Dude, when I read that book like crazy, it was people are going to be like, "Why'd you cut him off?" The reason's because it's a conversation. Stop telling me. I was reading The Art of War, so we were, sorry if the other side's listening to this podcast, but also thanks for listening. I was in a lawsuit over a house. So we were going to buy a home, and my wife was like 8 months pregnant at the time. 3 weeks before this house is going to get closed on, an oak falls on the house. An oak, like 100-year-old big ass tree. I'm not talking about a shrub. Falls on the house, crushes this laundry room that they had, and hit the rest of the house. This crazy woman says to me, "Yeah, we're gonna get it fixed in 3 weeks." I was like, "I don't give a shit what you fix. This is material damage. I'm out. Like, I am not buying this house. I got a
Seems
baby
reasonable.
on the road. Like, I'm not trying to live in a construction site. There's just no way." So they tried to force me to close on the house, and they wouldn't give me the escrow money back. And I was like, "Oh, we're going to court for sure." Like, I mean, I'm not litigious, but I went to law school. My wife was an attorney. Like, I mean, if you're not going to fight then, when are you ever going to fight? Right. So I remember I was trying to get her a little bit riled up with some of my stuff. I was reading Sun Tzu, and
trying to
it's
get
like,
her angry.
Yeah, man. And I do think it worked. Ultimately the guy called me and he's like, I'm thinking that I'll give you 20% of your money back and we keep 80. And I was like, I'm thinking that's not what's going to happen.
20% discount on the house is what I'm thinking.
Yeah, well, I ended up going to a judge, and I sat in front of the judge, and I was like, just take a look at these pictures and tell me, because it was like a pre-settlement or a pre-trial settlement conference. And I was like, look, man, I'll settle this. Like, I get what it's going to cost me to go through this. But if he thinks for a second that he's the one that's getting 80, like, there's no way that that's the percentage. Like, I'll fight this before that. So anyway, long story short, the judge talked him into some reason, but Sun Tzu is what got me through that.
So it's funny. I've read it through my life. Like, I probably had a go at it every 5 years or so, and it's just never really stuck. But for some reason, the last time that I read it, which is like probably 3 or 4 months ago now, it just all of a sudden I just like understood what he was talking about. It all started making sense, and I started being able to put it into context with what Buffett does, and I started being able to put it into context with like what UFC fighters do. It's so strange. Like, it was just all of a sudden it just made sense to me, and I don't know why it clicked all of a sudden.
How does UFC and Buffett come together?
All right, so Israel Adesanya is he's a Kiwi Nigerian middleweight fighter. So I have cut to middleweight, so that's 185 pounds. So I'm kind of interested in this. Okay. And he's like, he calls himself style bender, because he like doesn't practice one style, but basically he's a kickboxer who's like an expert striker. And he's just this terrifying prospect because he looks really tall and skinny, but he's just so precise. He's undefeated in UFC. And he had this last fight against Paulo Costa, who's Brazilian, who's really well-built, stocky kind of guy, who's also a Brazilian black belt in Brazilian Jiu-Jitsu. So this is always the challenge in UFC is always, the interesting challenge is always what happens when you get a striker against a grappler.
Okay.
Like, does the grappler get the striker on the ground and just ground and pound him, or get him in just submit him, choke him out, or get him to tap? Or does the striker sort of keep the grappler at distance and keep on like just belting the grappler until he gives up? But Paulo Costa's both a grappler and he has he's incredibly strong. What he likes to do is get guys into the corner and just wail on their body. And they're not knocked out. What they do is they kind of drop down the ground and just cover up and stop fighting because he hits them so hard on the body. So everybody was like, what happens when you get Adesanya, who's sort of very precise and kind of tactical in the ring, against this guy who's just going to charge him and wail on him? And so Adesanya's kind of taunting him, like in the build-up. Like, they always do this, right, to get people to watch. They kind of taunt each other and go at each other. But this sort of seemed to be a little bit more real than normal because they've been going on for quite a while and trash-talking each other. So Adesanya, so Paulo Costa comes to the face-off. Like, they have a weigh-in and then they have a face-off. All of this is just for the cameras, but it's good stuff. And so Paulo Costa brings a white belt in jiu-jitsu and he throws it at Adesanya as if to say, you're a white belt in this, and I'm going to either take you to the ground or, that's where the fight's going to go. So Adesanya throws it back at him, and Paulo Costa kind of overreacts and throws his arms up in the air. And then Adesanya throws the Karate Kid, like that stalk pose, whatever it is. Like puts his hands up in the air and lifts one leg off the ground. Like, just hilarious kind of stuff. So they get into the ring, and everybody's like, Paulo Costa is going to charge this guy because Adesanya's been provoking him the whole time, making him as angry as he possibly can. And he gets in the ring, and at no stage does Paulo Costa kind of ever get into the fight. He doesn't ever start throwing punches, doesn't get him up against the fence, doesn't wail on his body, doesn't do any of this stuff. Like, Adesanya just picks him to pieces, just keeps on hitting him, and like doesn't really ever connect really, really well. Like, he gets this glancing blow, Paulo Costa goes down and basically covers up and gives in halfway through the second round, I think. And so then they interview Adesanya afterwards, and he was like, so basically what he's done he knows that Paulo Costa is all riled up and desperately wants to charge. And what he does is he keeps on moving and giving him these different looks, these different shapes. So when Paulo Costa runs at him, or Paulo Costa gets ready to run, Adesanya just subtly changes shape. So he can't then move, because if he moves, he's gonna eat a big heavy punch from Adesanya. So what Adesanya's done is just like stuck into the ground, so he can't ever move, can't ever get into the fight. And what the Art of War has done, so he's got into his head to make him really, really angry and make him want to charge, but not giving him any opportunity to do that, and made him think that like that's what he wants him to do, because he wants Paulo Costa thinking, I really want to charge, and Adesanya also wants him thinking that's what Adesanya wants me to do. So he just like, you can watch the fight, he doesn't do anything. He's stuck to the ground because Adesanya changes shape, changes stance, gives him different looks all the time, because he's trying to tell Paulo Costa, the moment that you charge, I'm going to hit you short or kick you or something. And he just doesn't get into the fight. So that's Sun Tzu, I think, using deception, making your enemy angry. He's kind of, and he's planned this from really early on. And it's kind of one of the things that I love about fighting. Like, you can watch that Rumble in the Jungle documentary with Ali and Foreman.
Yeah.
Where Ali spends the whole thing saying, Foreman up to that point was this super, super heavy puncher. And Ali was sort of more of a dancer, and they didn't know if he could take like this kind of punishment that Foreman would dish out. And he was a little bit towards the end of his career. Foreman was a little bit younger. And so every time they ask Ali, like, how are you going to deal with this heavy punching? He's like, I'm going to dance. I'm just going to stay out of his reach. And so Foreman spends the whole preparation practicing with smaller, faster boxes. And Ali teases him by saying he's like a zombie, he just kind of marches forward. And so a Foreman's like trying to cut off the ring and trying to get more nimble. And then they get into the ring, and Ali just stops, just like puts the gloves up, and that's the rope-a-dope, right, where he famously like just leans back on the ropes. And Foreman just punches himself out, like doesn't ever kind of hit Ali with anything that hurts him, just kind of punches him on the arms, because Ali's all covered up. And then like Ali senses late in the fight that Foreman's getting tired because he's punched so much, and then Ali comes alive and just destroys him in this flurry of punches. Like it's a kind of you think about like, when would you ever use this stuff? Of course you're going to use it when you fight somebody in the ring. So I think it's directly, like, it's easy to see the application there. But there's this other element to Sun Tzu that's the obvious application of Sun Tzu, right? Where you're in a fight. But there's this other application of it, which I think is actually much more interesting, which is much more subtle. It's buried inside Sun Tzu. And I think you've got to go to John Boyd, he's the fighter pilot who was the Maverick, who Top Gun is based on. Like, when you read the book of John Boyd, it's hilarious how many lines out of what John Boyd says, or the stuff that he did, that turn up in Top Gun. It's clearly based on him, from the fact that the guy's called Maverick to the famous like pancake move where the not Viper, but whoever the second in command. You know who I'm talking about? Is it Viper?
I mean, I don't know why I can't think of Val Kilmer's character, Iceman, and you got Goose.
No, this is the Viper is.
People are gonna shit right now that we can't think of Top Gun people. I used to watch Top Gun every single night of my junior year of high school. I would watch it every single night. I think it might have been on VHS. I'm dating myself, but it was so dope.
I've watched it. I could just about quote it to you verbatim, start to finish. But
except we can't tell what characters they are, so everybody thinks we're full of shit.
But there's this scene in it where he's got the enemy plane, and I can't remember whether it's the MiG or if it's a training drill who's behind him, and he does this pancake move where you just put the plane vertical and it stops it.
Yeah. He hits the brakes and they fly right by.
Exactly.
I think that is Viper. Yeah.
So that's a famous John Boyd move. Like Boyd kind of came up with it. So Boyd was in Korea, didn't ever face combat, like only kind of went on these training drills, and then he was going to deploy to Vietnam, but he got called back to the Pentagon because they needed some advice on some of the fighters that they were building. And he had developed this, like he said, the book is great. The book is worth reading for anybody who's thinking about that. But he was sort of saying the problem is that you don't want you don't necessarily need outright speed. What you need is maneuverability, because you need to be able to get inside the turning circle of the other plane so you can get guns on them and shoot them first, hose them, as he calls them. And it's hosing because the bullets, like as you're turning, the bullets come out and they kind of lag like a hose does. So
that is a badass term.
Boyd apparently was like watching, I think he was watching Top Gun in the theater, and he just like got right into the battle, and he stood up in his seat and he was like, hose him, hose that motherfucker, something like that. So they call Boyd back. Boyd develops this, everybody sort of knows this much about Boyd. He developed this, the OODA loop: observe, orient, decide, act. And initially it comes from fighter pilots, where you've got to get inside their turning circle. Then he takes that concept and expands it into, you have to get inside the decision-making process of the enemy.
Yeah.
And so the faster you can make decisions, the faster you can observe, orient, decide, act. If you can get inside their turning circle, inside their OODA loop, I mean, you do it faster than they do, so you're reacting faster to what they do, you'll defeat them. So then he develops this theory, and he keeps on expanding the theory, and it's kind of like, I've read, there are various presentations of his online, and you can see the PDF, and you can see him delivering it on YouTube. It's kind of mind-blowing stuff when you see how he breaks down the problem. Like, he moves from very specific inside the fighter jet to like expanding out into the tactics and the strategy of it, to then expanding all the way out to grand strategy, which is like how nation states orient themselves against other nation states to make sure they don't go to war. And then he goes back down again through that abstraction all the way back down to tactics. It's kind of, when I understood what I was doing, I was just blown away by like this thought process. And it says in the biography of him, and you can see it in the presentations too, he like clearly likes Sun Tzu. It's hard to see what the connection is without understanding it, but when you go through it, like he latches onto something that Sun Tzu says and sort of magnifies it. And it's easy to miss it when you read through it, because Sun Tzu, it's kind of, it's hard to read. It's a little bit oblique when he talks about it. But the key, he says, so you need to, your objective as a nation state, or as an army, or as a unit, or as a business, or as a human, like you want to survive, you want to thrive, you want to exercise influence on your world. Like you want to cope with an ever-changing world, is the way that he describes it, and continue to like be a part of it. And so how do you go about achieving that? You need these concepts that he calls, it's like harmony, just blanking on a little bit, but harmony is the variety, harmony. I'll remember them in a moment. But the point is, like, he elevates this idea of harmony, which is something that Sun Tzu does well, but I just completely missed it as I read through it because it's really easy. The first thing Sun Tzu says is he's looking at these. You've got to go and work out what the conditions are that pertain in the field, and then he's like, by these 7 considerations, I can determine who's going to win the battle. And the first consideration is which of the sovereigns has the moral way, or exercises the moral law, or has the way. What he's saying is, which of the kings or monarchs or sovereigns or leaders of the business or generals in the army or whatever, it doesn't matter, which of them have the support of the people who are underneath them? So I know this is a very long bow, but that's basically
No, man,
solving.
this makes sense. I'm starting to understand where you're going with it. Keep going.
So this is the principal agent problem, right?
Yeah.
He's figuring out how to solve the principal agent problem. And then I
was thinking about reeling you in, but now I see what you were doing.
I'm going to get this.
I was like, what is he doing? But now I get it.
So this is the idea, right? And then as I read through this stuff, I'm like, holy shit, this is exactly what Buffett does. Like, Buffett has made himself invincible. Buffett has made himself a sovereign by applying these rules. And I don't know if Buffett read Sun Tzu and said, yes, of course, that's what you should do. Or if Buffett read Sun Tzu and was like, holy cow, this is really groundbreaking stuff. Or if Buffett has just tapped into these sort of ancient rules of the way that you should conduct yourself in the world in order to make yourself like, you can't actually be invincible, but you can do things that make you more invincible, and you can do things that make you more fragile and more vulnerable.
Yeah.
And you want to avoid the things that make you fragile and risk ruin. And you want to do the things that make you walk you towards being invincible. And anything can happen. You can get sick, you can die, all of these. There are lots of other bad things that can be visited upon you. But I do think that if you did this like Buffett has done, that's how you get a 50-year track record of outperformance or survival. Like, first of all, you have to survive, right? Buffett's gone backwards or he's underperforming the market for like 14 or 15 years now, something like that. But he's still running one of the biggest companies around. He's still the biggest shareholder in it. It's still a really, really great business. He's not going anywhere. He's got all of his firepower there. He still has it all there to deploy into Apple, to like put a third of his cash into Apple and have that then go up 3 times and become like one of the biggest parts of the business in like 18 months. Like, just that's the thing that blows me away about Buffett, that he's still practicing that sort of, it's not like when people hear me say Sun Tzu, I'm sure the initial reaction is like, oh, well, this is more of that activist bullshit. This is more of that attempting to be like trying to do some super macho, like aggressive bullshit, but it's not at all. If anything, it's a much more humane approach to the world, a much more sensible approach to the world. And now that I think in these terms of like, as I'm writing this book and thinking about this stuff all the time, now I see it in other people, and all of a sudden I'm like, yeah, this is, a lot of people have figured this out. I don't think that I've figured it out first, and hopefully I'm just going to put it into context for everybody else to say, these rules. Sun Tzu wrote The Art of War in 430 BC. These rules have been around for at least 2,500 years. And Buffett's just an example of someone who's practicing it right now to this day to massive success. So why wouldn't you want to know what these rules are and how they can be applied in business and industry and investment to sort of make yourself invincible? Like, I want to know what they are. Like, part of the writing process for me is figuring out what they are. And then once I've finished figuring it out, like, I'll tell everybody else. That's kind of the book.
So I got to ask you, if it seems from the outside looking in, like one thing, I don't care what people say about you, you believe in what you're doing, and like you are all in on value. That seems to me to be inconsistent with this Sun Tzu, like, set yourself up for all outcomes, right? Because like you're making a big contrarian bet right now.
So is it contrarian though?
To be deep value like you are and loud? Yeah, man. It's one of the things that I have mad respect for you about, because you get pummeled publicly a lot and you're out there. And I honestly, like, I mean, I know you, right? So I can tell people from me knowing you're not doing it because you're like tied to it. You're doing it because you believe it. That I don't think is easy. I don't think a lot of people have that in them to take on. And the other thing, real quick, before you answer, I was listening to Druckenmiller, or not, it wasn't Druckenmiller, it was Gunlock. And he said that, they tested the strategy that they thought, if you had perfect information 5 years forward, right? Well, could you win the game? And their answer to themselves was, I don't know if the answer is yes, because you probably go out of business because your clients would leave. And you have an ETF that you're marked to market on every day. That's got to be tough.
So that's 2 parts of that, right? So that perfect information, the Gunlock, I think, was it Gunlock? Was it? I don't know who that was.
Gunlock just said it to Real Vision. That's where I saw it.
I saw it today, but I think maybe you were talking about it today. I haven't actually seen it yet, but I know 2 examples that are similar to it. Wes Gray did a back test where he said, would God be fired as a value manager? And he finds God gets a 90% drawdown and gets fired halfway through, and God has perfect information.
That sucks. Poor God. But then again, he knew he'd get fired before he started it. So
you got God running your portfolio with perfect information. You're like, listen, God, you've underperformed for 2 years. You're out.
Yeah, sorry, the Momo Bros are beating you, God. I gotta go.
And then there's also Cliff Asness has done that other great test where he looked at, or his colleagues have done the test where they give the model the forward earnings from a year. So you're like, if you know where the earnings are going to be in a year, like you get this astronomical Sharpe and Sortino ratio, like you just crush it. Except you have these 2 years in 99 and 2000 where you go backwards, like the correlation is reversed. and it's happened again in 2019 and 2020. So clearly that can happen. I think you just got to be. For me, this process has been very good. Like I said to Jake, it's like it's like wandering in the desert and having your soul purified by just having like trying to do the right thing and then having a shitty outcome. Do the right thing, have a shitty outcome. Keep on doing the right thing, and then all of a sudden you're like, well, maybe I'm doing the wrong thing. Maybe I need to reconsider this whole process. So I went back and I just rebuilt the whole thing from the bottom up. And part of this Sun Tzu thing is Sun Tzu and Boyd. It's not just Sun Tzu, but part of this process is trying to work out what am I doing wrong, rebuilding the process. So then I've taken, there's a very theoretical part to it, but then the theoretical part, and I think that when people read the book, I don't know so much about the book because the book is written at a very abstract level. Like I don't mention value in it at all. I don't mention Buffett in it at all. I only talk about invincibility, risk of ruin, Sun Tzu, John Boyd, and I use Napoleon as the avatar because I think he's. I'll talk about that in a little bit, but the point is that it's not a value book. It's like it's something else. I don't know how to characterize it exactly, but basically, you've got to take those lessons and then apply them practically to the existing portfolio and look in that portfolio and see, does this satisfy all of these new criteria that I am imposing on myself that I think have been very useful for people in the world. And so I think probably you could hear it in the way I talk about some of these positions in a little bit of a different way. Like I don't talk so much about the multiple anymore. I talk about the yield and what you're paying for the growth. There's no difference in the way that the portfolio is constructed. It's just a difference in the way that I'm like analyzing the opportunity now. And I think that if any, and I say this quite a lot, and I really do think this is kind of true right now. I don't know how long this has been true, but it's certainly true right now. The portfolios don't need the market to treat them. The companies in the portfolios don't need the market to treat them any differently. They don't need any multiple expansion to outperform. They've got better yields and better growth, higher reinvestment rates. They're going to do just fine from this point on, regardless of how the market treats them. But that's all that process has done for me is just clarified what we're doing as investors. Like, what are we trying to do as investors? I don't really care how the market treats the companies after I buy them, because that's not why I'm buying them. I'm buying them because I think that I can get a particular yield and a rate of growth out of these, that the market treatment of them is irrelevant.
Yeah.
And that's the point that I want to get to. I think that's what makes you invincible as an investor. When you put something on and you say to yourself, I literally don't care if they shut the stock market for 5 or 10 years here, I'm going to be okay.
Yeah. I'm kind of close to that, but I got to be honest that I look too often, right? And like I do find myself, but I look at my portfolio and I'm pretty proud of. I mean, I really do think if I had to own this thing for 10 years, I'd be fine. The question that I wanted to ask you was, how do I have two questions. One, within your strategy, are you going to be able to stick with those companies, or are you going to be mandated to roll out? And two, what do the shorts do to the resilience of your portfolio?
So this is the good thing and the bad thing about running a explicitly deep value portfolio like the ETFs is that they are always rebalancing into the cheapest opportunities. So when you're in a market like this, where the multiple is being, the value stocks multiple hasn't been going up, it's either flat or down. That means that you're regularly rebalancing to something that's cheaper without having any performance out of the thing that you've already held, or even going backwards in that thing. It's not clear to me that buying something and staying in it for a really long period of time is any better than trying to stay clustered in the things that are very cheap. It's just that, I can put these positions on and then forget them, and then sell them in 3 to 5 years' time, and someone will be able to look back and say, "Holy shit, that was a lot of compound return that you got in that thing before you sold it." Or I can just rebalance more regularly into the cheap stuff, so to keep the portfolio perpetually cheap. you never get much credit then for having big winners, because you're never going to have big winners because you're rebalancing out of them more regularly. But you're keeping that portfolio evergreen, super cheap. So it's always primed for outperformance. So I do think that that's an entirely valid way of building a portfolio and managing a portfolio. But I would like to have a discretionary vehicle where I'm not compelled to sell out of them so quickly. The only thing I think that would achieve, I don't think it'll get better returns. I think the returns will be slightly lower. But I do think you get more credit for identifying things that are undervalued and holding them for longer periods of time. So it makes it it's easier for someone to observe that you are picking the right stocks and they're getting better returns because they're staying in there for longer and you can see the performance. But that's not the reason for doing it. The reason for doing it is just that I want a different vehicle where I can be more discretionary about what I put out just for fun.
So if I can recycle your answer to you, what you just said is, I think what I'm currently doing has the highest expected return, but I want to do something else because it's more mentally exciting.
It's not only the mental excitement part of it, though. That is part of it. That's 100% part of it. Because there are opportunities I get that don't fit into a deep value framework.
Yeah.
But I can understand them as a value investor. Even though that's a dirty term these days, like I still think of I know all intelligent investing is value investing, or whatever the expression is. But the idea is that, like, however we're doing this stuff, I think if you're a real investor, what you're doing is you're trying to figure out where this thing is going to be in the future, and you're trying to buy it at a discount now to that future price or that future valuation that delivers to you a sufficient return to justify you putting your money in over that period of time. It doesn't matter how you're doing it. If you're a growth investor, it just means you're paying a higher price, expecting a much higher price. If you're a deep value investor, you're paying a very low price, expecting a probably more
modest
average
price or whatever. Yeah.
But either way, you're still trying to maximize the return. You're just making a decision which gives you the highest return over that period of time. So all of the discretionary thing would just be to open up the palette a little bit more to sort of look at different opportunities. Having said that, I do think that there are some businesses out there that, like, in order, how do you go about constructing an invincible portfolio? Like, the process, I don't think, is necessarily, you don't look at the existing value opportunity set and try and buy those things. The process is different. The process is, what are the 200 or 300 invincible companies in the world? Like, an invincible company to me is something that everybody knows exactly what they are. They're just Buffett type stocks, but like just absolutely bulletproof balance sheet run by a management team who are investors, who understand what they're like. It's like we're going to reinvest in the business when that gives us higher returns. When the market trades down to the point that they're telling us to liquidate the business, we're going to buy back stock. We're just going to take our cues from, we're going to always maximize our IRR, however we're investing the money. We're going to run it on behalf of the shareholders because we are big shareholders. Like that's the kind of manager that you want. The business is bulletproof. Like, the business is not one that can be unseated. It just occupies a special position in the world, not by virtue of a patent that it holds, just by virtue of, Twitter's one of those businesses. Like, Twitter I don't think you could unseat Twitter. I think you can unseat Facebook and Instagram. I don't think you can unseat Twitter. Maybe not Instagram, I don't know. But I think TikTok's going to make some inroads into Instagram. I think Twitter's much harder because Twitter's much harder to use. So once you get in there, people are trying with Parler and...
Yeah, that's not going to go anywhere. It might for a certain speech or whatever, but not like for real.
The risk for Twitter, though, they can destroy themselves. Like, they can, that's one of the lessons that I'm trying to include in this book. Like, the invincible can lose track. So, one of the things that John Boyd talks about is creating a vision for your country or your business that is so noble that anybody who is sort of undecided is attracted to your cause. They just want to be with you and they want to see you succeed. And to create that, you have to behave in this sort of moral, just, fair manner. You have to do all of the things that we would agree collectively are good for society, good for your stakeholders. If you do those things, you have so much support from everybody that it's just hard to go away. It's hard for you to slip through the cracks. If you don't do those things, you create enemies who are out there trying to kill you all the time. And that's sort of what Twitter has done for itself a little bit here. They've created people are dissatisfied that they're being suppressed on that platform. So they're going to they're looking for Gab.ai and Parler are two. There are going to be others like Signal and various other things that are trying to, and I don't know if any of them are going to be successful. I hope that Twitter sort of figures out that it should be more of an impartial voice, or it runs the risk of being blindsided, because this is one of the things that Boyd talks about. He says, the way that guerrillas, insurgents overthrow, like, so if you're invincible, you're not defeated by a front on attack, right? The walls are too high, the army's too strong. You can't be defeated in that way. The only way you can be defeated is if you make the people who you're kind of ruling over, who you're governing, so unhappy that they're desperately looking for another solution. And they can find these guerrilla insurgent types who will come in and they will start supporting the guerrillas. And they'll help them overthrow you. So you have to be very careful about that kind of stuff. Now, I don't know what the solution is for Twitter. It may be that they think that they're making themselves more invincible by doing this stuff, by like they're suppressing some voices that people shouldn't hear. I don't know the answer, but I don't think that it's been a winning strategy where it's been applied in different contexts. So it's one of the things that I'm nervous about for Twitter. But other than that, I think it's kind of one of those invincible businesses potentially. So that's kind of, when you think about it in those terms, then the only way that you then can approach these businesses, it's not a value first proposition. It's an invincibility first proposition. But then you can also kill yourself by just overpaying for these things. Not so much kill yourself, but if you overpay, the market price goes against you so much. Like if you pay 10 times more than they're worth, it just takes too long for you to catch back up to what you've overpaid. You still need to pay you still need to pay enough to get a reasonable return out of these things. So the strategy then for this kind of investment style is just to be extremely patient and to wait for your opportunities in these 200 or 300 businesses that have these qualities globally. When they get to a point where you're going to get a sufficiently high return out of them, whatever that is, say, whatever your hurdle is, 10 or 15%, something like that, where if you can get that return out of them through the yield and through the embedded growth, that's when you take your position. So you wait for events that aren't company-specific events. You wait for like a March 2020 opportunity to invest in them. And you won't get all of them because they won't all come back far enough, but you'll get a handful, and then you just wait for your next opportunity. And you use other strategies like, underwriting some puts to get into them, because I think you can capture some of the vol. There's lots of other things you can do to generate returns while you're trying to take that position. And then I think when you get into them, you never sell them. Like that should be your approach.
Yeah, I don't know how I feel about the never sell thing. I think that there's a lot of merit in it. Something that I own that's run a ton is this Colony, and McMurtry talked about it on the last podcast. That is a business that I think has some options to it that are very, very hard to price and underwrite, but it's got some real momentum going on. And the guy that came in there, like if I'm sitting in the allocator seat, I can see why he's the guy that I want to bet on. I think he's good at whining and dining people. I think allocators have to justify their existence. I think where the yield is in the world, like alternative assets are going to continue to be in high demand. I think digital infrastructure is an easy thing to tell your boss that you're allocating to. So like it's hard for me to get off that train, even if I think the stock is maybe even a little bit ahead of itself. Then you got, some of these other businesses, like TransDime's one that I'm kind of struggling with. And I do understand why people think it's worth what it is. And I can even see why it's worth more or whatever. But fundamentally, it's just harder for me. I think where I'm more comfortable with the never sell thing is like, if you're in a business that has a lot of potential embedded options in it and you bought it at a good price, and the management and the employees are competent and really attacking a lot of different lines, that's where I think this never sell thing makes a lot of sense. Or conversely, if it's like Coke or Geico, where you're convinced that it will end up catching up with the stock, right? But in some of these businesses that I think are slightly by nature a little bit more defined in their TAM, for lack of a better term, like that, I think I'm more comfortable trimming in.
So here's the thing about never sell. It doesn't apply to most businesses. I would only ever consider it for like these 200 or 300 of the best businesses in the world, because they're so hard to get into. You're just not going to get very many opportunities to buy these things. They're always going to trade at a big premium. So when you get your opportunity to buy into them, you got to jump on that opportunity as hard as you can. And then you got to say, that was really lucky that I got that opportunity. I'm never selling this thing because it's such a great business and it's going to keep on going for 25, 30 years. Like, we all know the base rates on those things are very, very low, but that's why I'm saying there's like 200 or 300 in the world out of whatever 40,000 publicly traded companies. Like, they're vanishingly small. And then you got to watch them. And the reasons that you sell these things are not valuation, because they're just so hard to get into. You know that over a long period of time, your return on it is going to match the return on invested capital. It's not so much what you pay, it's what you get when you buy it. So the things that you're watching for is the management team losing its mind? Are they starting to, the guy who was the one who understood making this thing invincible and making it a solid return for the shareholders, is he gone or she gone? Then that's a problem. Is the business losing its invincibility? Like, are there just better businesses popping up? Because that happens too. They can't all stay at the very peak all of the time. So that's the sort of process I think you're looking more at, like a diminution in the quality of the business or the quality of the opportunity rather than the valuation. But I agree with you. For like 99% of businesses that are out there, when you get your price, you sell.
Yeah, I mean, it's just hard to watch what most businesses go through. I mean, even Microsoft, even Coke, like, I mean, these really, really great businesses, it's super easy to look back where the valuations are today and say, well, hey, they even outperformed, the Nifty 50 outperformed. I mean, I get it, but also there's a different question between theoretically looking back, what did this business do? And as an investor, could I have dealt with this kind of underperformance and had the confidence that it would come back, given the fact that the reason that it underperformed was that most people threw in the towel? Or if not most, many, right? Like, the narrative definitely changed. And that multiple fade is really hard to tell yourself year after year after year. Like, oh yeah, the business is getting better. Okay.
It's not to say you never trim them. I think it's appropriate to trim sometimes. I just don't think you want to be out.
Yeah, that's where I've settled. That's where I've settled too.
You just may never get your opportunity to buy back in. I mean, that's the thing because these things are so, because you're almost reversing the process from like deep value, where deep value is just, you take your opportunities where you find them. When something gets cheap, you buy it. You don't buy too much of it for your portfolio because you know that there are risks attached to it. It's cyclical, whatever. Management's not that great. There's some sort of catalyst, some sort of process. You're trying to catch that part where the market recognizes, oh, we probably sold this one down too far, and then they pop back pretty quickly. For these things, it's sort of, they're so hard to buy. You just, Coke is a good example. Like, everybody criticizes Buffett for not selling Coke, but like, what are the chances that you ever get the opportunity to buy back in? I mean, I don't think that's really ever got cheap. It hasn't worked, but it's not got cheap. Meanwhile, he's been clipping out like gigantic dividends every year that he's been redeploying. I mean, he can't be too unhappy with the investment, even though, he probably could have sold it like in 2000 or something like that. But I think that when you're his size, it becomes incredibly difficult to maneuver. Like, he gets that capital out, he pays tax on it, then he's got to redeploy it. Like, the one thing he's got too much of at the moment is capital. Like, he doesn't need more of it to redeploy. And what would he have done with it? Would he have been able to get those kind of dividends out of it? I don't think so. Like, if the 10-year was at 6%, that's a different prospect, right? If you've got a place to stick your money when you pull it out, but at the moment you don't, you might as well leave it in a productive asset.
Sort of why I own cigarettes. It's a little bit different. I mean, if I could wave a magic wand in the world and cigarettes disappear, fine, I'm down for that. But like for my personal life, I don't have Buffett's float, right? I need a cash flowing asset to give me cash flow. And I'm getting almost 8 to 10% on a look through basis selling cigarettes.
And the
Like that
yield on
is
them
a
is like that, right?
I know. And like I don't love that they exist, but I'm also not issuing like new fresh money to them. They don't need my capital. So to me, like I sort of look at that as like that's my front end cash flow to invest in the compounders down the future. And yeah, the terminal value is probably, leaves a little bit to be desired. But if you're talking about further than 10 years out, I'm hoping that I can do something with that 10% yield in the meantime.
As
That's
a
the
deep
bet.
value investor, I'd buy them. As an invincible investor, I wouldn't because it fails the harmony test.
Yeah, I mean, I might be bringing karma into my life that's
It's not.
bad. I'm trying to
It's not so much.
reciprocate other ways.
It's not so much karma. It's like I think that's. I've been thinking about that a little bit too. Like, what is the mechanism? There's this idea. Ancient Greeks had this idea of hamartia, which was it was like your moral flaw that came back, and you just kept, and often it was hubris, so that's ego. Whatever the thing that kind of propels you to success is also the instrument of your own destruction. So it's this idea that the gods are just in punishing you for doing whatever it is that you've done to get yourself there. So the classic example, Oedipus, where the Oedipus's mum and dad get the message that he's going to kill his father and have sex with his mother. So they're like, oh my God. So they pin him out on a rock by his ankle so he can die. And he's discovered by this shepherd who takes him back to a different town and raises him. And then Oedipus goes to visit the oracle at Delphi. And the oracle at Delphi says to him, you're going to kill your mother and kill your father and shag your mother. And he's like, oh my God, I don't want that to happen. So he escapes from, who he thinks is his mother and father. And he's on the road, I think it's to Thebes, where he runs into this like very arrogant man in a chariot who won't move aside. So he gets into an argument with him and then ultimately kills that man. Of course, that's his father. And then he rushes into town to find his mother, shags his mother. So he fulfills the prophecy and
world.
In trying to escape the prophecy, he fulfills the prophecy. And this is something that, I think that cosmic justice is another name for it. Poetic justice, karma.
You're going to make me sell these things. I need to call up Lawrence Hamtill right now.
But it doesn't work like that. I'm not saying you get punished for it, for investing in it at all. What I'm saying is that if your business creates disharmony, it invites attack. And the way that cigarette companies have been attacked in the past successfully is through lawsuits from people who've been hurt and by the government. And so there are two avenues for attack that have been successful in the past, that somebody might just pick up that cudgel once more and like beat them over the head and say, look at they're paying 10% dividends. I can clearly afford to pay a whole lot of money and like not retribution, like reparations or whatever. So that's I'm not criticizing you at all. This is a brand new kind of process for me. I'm still trying to work my way through it, but that's the way I'm kind of thinking about these things. Like, are you putting out good stuff into the world, or are you inviting attack? Because if you're inviting attack, I just think you're going to get attacked eventually.
Yeah, that's fair. I think that the counter in that particular example is they've been attacked for a long time and tend to make it. And governments kind of need them to survive if they want that tax money. So it's somewhat of a mitigant.
It's the filthy lucre.
So I got to go back because I can't let you off the hook with the shorts. What's your process with the shorting? Because I know you have a momentum overlay on it.
So the idea, the function of the shorts, first of all. So I think, it's my bias as a deep value guy, but I just think that the market is stupidly expensive. The opportunities are so few at the moment. There's stuff around for deep value buyers, but I think that there's a lot of things that I look at, like, CNN Fear and Greed. I don't know where that is today, but we're at like the highest readings we've ever seen on that thing. Like, we're higher than we were in 2000. That's bananas. The world was pretty euphoric in 2000. I think there's just this pervasive belief that, and 100% reinforced in March, that we're never going to have a real stock market crash again because the Fed is omnipotent and the federal government can bail us out. And I don't, not that I really know exactly what happened in the 20s, but it does feel a little bit to me like they've eliminated all risk from the market. People are just, nobody thinks about the downside anymore. You're just guaranteed that the market goes up a lot every year and you're going to make even more money than the market because, you're in the smart stuff that goes up a lot. You buy the tech stocks that go up, the compounders, Tesla, you don't ever think about the downside and you get rewarded for it because you're aggressive and you're smart. I think that that's a trap because I think that when the market has historically been in this kind of place, the forward returns haven't been great and the outcomes have been bad, lots of volatility and so on. So I think that that's probably coming at some stage. I don't know when. And when that happens, I want a life raft. And my life raft is the shorts. And so the shorts have delivered a little bit of performance, which I've been pretty happy with, except for this quarter. This has been a painful quarter for the shorts because what the shorts do, I have this momentum overlay. I'm just looking for stuff that's not gone up because they're already. So the problem with shorting, you can find something that's got a garbage balance sheet that's losing money all the time. That insiders are selling all the time. They're just raising debt. The only way that they're kind of surviving is by selling equity because the market falls in love with the story. And Tesla, I think, is a pretty good example of that, where anybody who's a fundamental analyst really looks at Tesla and just can't figure it out. For one thing, the financial statements change so often that you can't even get a quarter to quarter, year on year look at what the business is doing, and they're impenetrable. They just don't make any sense. And I'm not saying that I'm the world's greatest forensic accountant, but I read the financial statements and I don't get it. I talk to other guys who are pretty good financial forensic accountants, and they don't get it. I'm trying to get someone to explain it to me, and the only argument I hear on the other side is from dudes who are like, if you could only talk to a bull, you'd just understand the story in this thing. I'm like, everybody's a bull. Everybody's a bull. Everybody tells me the same story.
I'm not. I'm just smart enough to stay on the sidelines.
I'm not shorting it either. Like, I'm just giving it as an example of one that I'll talk about. But this quarter, what happened is there has been a pretty big rebound in very deep value, and there has been this commensurate move in momentum where the high momentum stocks have come back and the low momentum stocks have gone, or the bad momentum stocks have gone up. And I've just been caught a little bit because I use that momentum I'm trying to find stuff that's down. A lot of it has rebounded. They say don't short in the hole. Sometimes what this strategy will do is short in the hole, which is what it's done this quarter.
What's that mean for the uneducated of us?
Short when it's down a lot, and then get the rebound in the face. So I think this is the worst quarter for the shorts. That's going to happen every now and again. I still don't want to change it because when I look at the full back test of data that I have, it's been a good strategy, and it saves your life in so many different scenarios that it's worth keeping in there. It does introduce some risk in the sense that there's some embedded leverage in the shorts. We mitigate that a little bit by not always being 130% long, unless the opportunity set is just so mind-bogglingly good. I think there's a lot of risk in the market at the moment, so we've got about as low an exposure as we can take to the market. We're 100% long, 30% short, so for a net 70. And so when the shorts bounce in that kind of market, when you're only net 70, the returns are flat. Rather than being up a lot, we're sort of flattish to up a little bit, which is okay because I still think that when I step back and look at the opportunity set at the moment, the global opportunity set, it's very, very unappetizing. And I get the feeling we're just going to walk into there's something else that's going to happen and everybody's going to say, well, that was specific to that thing that, the market falls off because of COVID. Well, the market was already like pretty toppy and bulled up. Like all of the signals were there before March. It's just that it happened in March, and then we could point to the reason why. And I think that what's going to happen in the future is the same sort of thing. There'll be a specific reason why it falls over, but that's not the reason. The reason that it's expensive and everybody's pulled up. There's nobody on the other side of the boat.
Yeah, I mean, when you think about the amount of SPACs and the IPO filings and the S1s and the retail participation, I mean, when you read the books of how things sort of get towards the higher end of high, to say that there are no signs of it right now is sort of like being delusional, right?
So let's talk about why we're only in the third inning though.
Okay, let's do it.
Let's take
For the value after hour, for the non-value after hours, folks. Toby and I do a podcast, and I joke about us being in the third inning all the time. So, well, I have said the second. I said we moved to the third recently. So the melt up. The reason
hit me.
that we're gonna melt up is there's nothing else to do, man. Like, I don't know if you're investing assets right now. I just don't know where you put your money. And I hate to be like a Tina guy, and I can totally see the risk out there, but I guess you could go super long duration bonds. But like, I view a lot of these software stories, specifically FANG, like let's talk about the cash flowing, growing software companies or, digital companies.
I might be increasingly coming around to Netflix, by the way. I'm increasingly persuaded that there's something to it.
There is something to it.
So I've always said it's like famgy, like it's an insult to have Netflix in there, but I'm kind of like, you know what? They've got people paying for a growing, and like they do now have, you're just on a subscription. You're not going to cancel that subscription. So they've got this money coming in. They're just going to stick it out there and get some good stuff and some bad stuff. They'll figure it out. They're probably going to win. I mean, they probably won.
Well, and the thing about the good stuff and the bad stuff is like the bundle has always had good stuff and bad stuff. That's not like a unique problem to Netflix. It's just a unique problem to people's perception because like HBO was the old premium service that you would add on. Now Netflix is. So I think the expectation of it is changing. Like,
let me just throw this at, before you go into the melt up. Let me just throw this at you. Like in a world where everybody gets into their own niches increasingly, like why the fuck would you want the whole smorgasbord of shit that all of the normals are listening to?
I think that the thing about Netflix, that is who you're asking about, correct?
Yeah, Netflix.
Yeah. So I think that they're going to be able to make their own bundle from their own content. And I think that the reason that I'm not comfortable buying into like HBO Max or some of these other direct to consumer stories is I think that the pace at which Netflix introduces new content attacks the mind share of people's back catalog much more than a lot of people appreciate.
What do you mean by that? The mind share of the back catalog?
Yeah, so like if you're in Viacom, right, you're relying on their back catalog to drive some subscriptions or even Discovery or whatever, right? Like it's for a long time in Discovery, Zaslav said, we make unique content and no one can replicate it. The thing is, that's BS in Discovery, but for purposes of this, that's what he says. Netflix is starting to come after that.
Yeah.
And maybe Discovery is not the best example because you don't like that content, but I think that there's a lot of back catalogs like that. Now, NCIS, something like that could have value because it does have retention. But
here's the weird thing, right? Like, I kind of see a world where everybody like, I don't want to watch network television. Every time I accidentally turn on network television, like to watch, something was on network television, could only watch it recently. I forget now, whatever it was. Oh, something like the Thanksgiving Day football games.
Yeah.
I was just like, it's been so long since I've tuned in. I was watching it and I was like, these ads are just so garbage. Like my kids are sitting here watching these ads. I'm sitting here watching these ads. Like I'm offended by these ads. Is this what people are watching? Then they're advertising their shows. I'm like, these shows are just garbage. Who is like lining up to watch this stuff? And so I kind of think it's not what the aim for the television channels used to be least objectionable program. Like you're kind of locked into a handful of program channels that you can go to. And so you just got to put on the least worst thing at any point in time and you get all the eyeballs. Now it's a kind of different world where there's so many options, and I can go and watch them, on demand. You really have to have something that I want to go and watch, because otherwise I'm not going to sit there with the Discovery, you know, gold mining in the Amazon and just let that play all day long because I've got nothing else to do, because I've got other things that I can go and do.
All right, I'm going to say something that's going to really offend a lot of financial folks, especially value investors. If I'm Reed and I'm in that situation, I'm the CEO, and the capital markets will allow me to spend absurd amounts of money and discount it because of like per eyeball spent. And it's not even the equity market that's allowing me to do it. It's the debt markets that's willing to fund it. And I'm almost cash flow positive. Like, why would I not just like, damn the torpedoes? We are going to just go nuts. And like, financial analysts are caught up on a free cash flow measure that like, this guy's not even playing that game. He's going out to kill everybody. And like, you guys are talking about free cash flow. He's just, it's not, fair. And I think that's what people are missing. So if it doesn't work, the stock's probably overvalued, right? But if it does work, and I'm starting to think it's got a higher and higher probability of working, you get to one of those like almost, I can make the argument that they're an inevitable. I know that like Roku bulls will roll over and laugh at that, but I mean, that's the bull case. And it's not a zero probability. I don't know how to assign the probabilities, but I'm increasingly thinking that it's more inevitable than I ever have.
Yeah, I wish I was a little bit better at that game where you can kind of work out what is going to happen in the sort of short to medium term. Like I mean this genuinely, like to figure out the strategy that Reed Hastings is chasing there, and to kind of figure out what that eventual valuation is worth. Because I think you could get that insight in a handful of places, but I just think it's also such a massive trap where you just totally delude yourself on something.
Yeah.
And totally just rip your face off being way, way wrong. So that's why I'm always nervous about sort of going too far beyond what you can already see in the cash flow statements. And I sometimes think, although Buffett doesn't always do this, but I do think that he's done a lot of that where there are some situations where, it's a big upside, but it's really hard to kind of figure your way through it. I'm not saying that that's Netflix. Netflix is not the best example of that, because
I understand what you're saying.
Netflix is a closer term sort of. You can kind of see what they're doing there. That's visible in the financial statements, but there are a lot of things out there, some of the more popular SaaS names and so on, where you really got to see the end state and understand the end state. And it's possible there are people out there who have figured that out, but for a lot of these things, I'm like,
I don't buy it, dude. So like, how long did it take me to get to Netflix? And I probably should have seen it. I think realistically, when I could have figured it out is probably 2018-ish. And like, then I think the other thing that value investors maybe would benefit from thinking about is like, how's this thing going to trade in the future? It's not ever going to, I mean, in a realistic world, it's not going to trade at a 10% free cash flow multiple. You're talking about a subscription business with global scale. It's at least a 20 to 25 time free cash flow multiple.
But you can, if you're valuing these things rather than just looking at the multiple, I don't know how funny that sounds, me saying that, but if you're like digging into it and saying, you look at any of these kind of eBay, what was I looking at? Some of these things I was pulling up yesterday. I had a look at eBay and some of these old, like the return on invested capital in these things is just comical. It's like 1,000%, 1,600%. Like there's just nothing in their business. And I think it might have been, I forget now exactly what it was, but just the return on capital was just stupid. And they're going to pay out a lot more capital too. So basically they don't need any capital in their business.
Yeah.
The business is just basically run on, I've got no idea how it's powered, but it doesn't need money. Like money's not the thing that makes this thing go round,
Well, it's all through the income statement, right? So once the cash flow drops out, like they don't really need the traditional working capital and PP&E that a normal business would.
Yeah. Yeah.
It's just like it's a cash
fixed
machine.
Assets either.
Yeah.
Like look at Apple. They're like, what are we going to, we've got so much cash here. We can go and drop $1 billion on a headquarters, and it's like it's a rounding error.
I mean, dude, what's nuts is what they've been able to do with semiconductors. And I'm like just starting to study the semi space, but I already understand that what they did is pretty crazy.
What have they done?
I mean, I'm going to get over my skis technically, but
That's why I
it's,
asked you.
yeah,
Tell me
no,
what they've done.
no, I'm not even going to get into opining on the semi space. What I do know is that they've done a lot of stuff in house that even semiconductor companies probably couldn't have done. And that's probably where a lot of the R&D went.
Uh,
So anyway, I think the thing that's tough is like with a Netflix is, but the art of it all is parsing like what is just like Reed damming the torpedoes versus what does this actually need to sustain itself and maybe grow at 4 or 5%. I mean, it's a very imprecise science, I think. And then
yeah.
once you start to apply that same level of thinking on like these software companies that are $100 million, I mean, maybe they're $1 billion revenues, but they're not. They're $600 million, and they're trading for
Yeah.
like 36 billion. I mean, I get it. I really did, and I would have said this a year ago, and I'm bound to be wrong again. But like once you've gotten to that point, in my mind, why would the valuations not go higher? Like it's all, you're already assigning a whole lot of certainty to the future. So I think that we're not saying that we're disconnected from fundamentals there. I don't think is an accurate statement, but I just think that it's all sort of dreams anyway. So why can't they get loftier?
But here's the thing. So just to go back to the which inning we're in. Like, why do you give a fuck?
I don't. Half of it's to troll Jake.
and me.
Yeah.
And me. But I kind of like, I'm just like,
the reason I say inning 3 is to convey the point that no matter how high, like however crazy you think it can get 3x crazy. Like there's no difference.
You know, John Borman, who passed away recently, Vale John, but they had this great, somebody tweeted this out and I retweeted it when it came out too, because it was a great line where John said, I think he was talking about Tesla, could have been Netflix, I forget which one exactly, but he said, if you short this thing on valuation, the problem that you have is that the further away from valuation this thing gets, the better you think the short opportunity is, and the more kind of underwater you are on this position. And it was kind of like, there's something interesting in it from the like that's a big risk for shorts. But I sometimes think you kind of, if you spend a lot of time in the markets, you start thinking like a markets person, and I don't think that's a very helpful way to think.
Yeah,
I think you want to think like, I mean, you want to think like a business guy in the markets. Like you don't want to be so sophisticated that you know the impact of something on the multiple or any of that kind of stuff. You want to kind of ignore that stuff. I think all you want to think about is what yield can I get out of this, and what is the underlying growth going to be worth to me buying at this price.
Yeah.
And I think when you approach it like that, I think it simplifies a lot of things. Like you can look at something like what's the thing you've got the bet on?
Oh, Zoom.
You can look at something like, sorry, I just completely.
It's okay. It might as well be any of them.
I log into it like 5 times a day, so I should be able to remember it. But Zoom, like, and I don't know the numbers well enough to kind of know, but you know, you can, the growth part you can see is very, very good, but what you're paying for that growth part has to be so successful as like not looking where the share price is going to go. Like if it stays elevated relative to the business, then yeah, it's going to be a great performance of that for that stock over the sort of short to medium term. But if you're a business guy and you're looking at it and you're thinking, what flows am I getting out of this thing as I buy it? You'd look at that and you'd say that, gee, a lot has to go right for me to kind of get my money back here.
Yeah. 100%.
Do I want to be in those kind of, I want to be in situations where, like Twitter, like it's been run by a bunch of clowns who fell into a gold mine. It's been run by bozos for so long, and it's still here. People love it. People are addicted to it. I'm one of them.
Yeah, no doubt. I don't hold any of these things. I mean, I fully agree with you. I bet Zoom blind. I had no idea what the market cap was. I had my mom's friends calling me being like, should I buy Zoom today? Because people are sitting at home. Yeah, it's like, all right, it's an indirect way to go short that trend. I've got my wife. I mean, I work hard at this shit, right? My wife's friend is outperforming me because she bought some stay-at-home education company because people were staying at home. It's like first order thought has been so rewarded.
That's it.
That I fundamentally do not believe where the valuations are. Now, there are some thoughtful bulls out there that will say, like, you have a closed mind to a real opportunity. And to those people, I say, congratulations for knowing what's actually going on. I
Are there
have
other people
no
listening to
interest
this?
in
I
that
thought I've
game.
just been talking to you.
Yeah, well, pretty much. But you know what I mean? Like, I have no interest in playing that game. It seems like fraught with risk. And to your point on skew, if you're looking for high upside on the right tail, low downside on the left, at this point, we're still going to make the argument about SaaS with these valuations.
Yeah.
Like, fine, I was wrong last year. Fine. You're 4x up on some of these names. Like, you still think it's good risk reward to take? It's the betting analogy that Mobison cited, right?
That's
like,
it.
Yeah, fine. It's a great fucking horse. First of all, it's tiny. It's a foal. And if you know anything about horse racing, a lot of them die because they get injured. It's the same as capitalism. And you're paying a ton of money. It's a bad bet.
Yeah. The time to get that bet on was 2015. Like, you just had Microsoft, all of those FANG names were trading too cheaply in 2015.
FANG, I'm a little different on, man. FANG, I can understand.
I'm with you on the FANG names. Like, they're not egregiously overvalued. They're sort of like, I think that, well, last time I looked at them, which is a little bit, and they've all run a little bit since then, but like Google, I thought was in the vicinity of like a 12 to 15% return from here.
Yeah.
And like Microsoft was like 6 to 8%. Like, I think that's still expensive, but I don't think that might be justified.
I don't
know,
that
might
dude.
Be a fair price.
A 12% yield off of an asset as good as Google, like, that's pretty good value.
That's not yield. Was it
returns? Returns.
Yeah. So what I'm saying is that's partly yield out of, like, I'm talking shareholder yield, where I'm including the buybacks in that.
Yeah.
I'm just looking at, like, the way that I think about valuation is I look at, like I like the Greenblatt kind of idea of, like, looking at the, like, what do they really need in this business? And that's the fixed assets, the PP&E, the net PP&E, and the net working capital, right? Like, that's the money that you would need if you were to buy this business for the assets. That's what you have to pay for it.
Yeah.
No one's ever going to sell it to you for the assets, but that's what you pay for it. Then that's what it's producing. Then you look at what it kind of throws off. And then I go and look at the financing cash flows, and I look at which way they're going. Like, is their money going in or out of this thing? And then you try and track down where the money goes. That's the hardest thing, I think, to figure out. Where the money is coming in here and then going back out here, and they're earning this much on the assets, but there's always this shortfall, and I can't figure out where it goes. There's this shortfall between what gets paid out as yield and what they've earned on the assets and reinvested, but it doesn't show up in the reinvestment. It's the trouble that I have with most of the companies that I look at. There's this, like, little shortfall in there all the time, and I can't figure out where it's going. I just don't know. Like, maybe it's going into unproductive assets and it's just not showing up in that analysis. Maybe that's what I'm doing. But I need to. It's just, I'm totally talking off the cuff here. It's not something I've thought about. I'm literally thinking about this now while I do it. But it's just that, like, it's one of the weirdest things I find when I'm running through these little valuations that I do, just like back of the envelope, just to see what this thing is roughly doing. Because I'm interested, like, what's Google doing? What's Microsoft worth? Where are they trading? Where's the yield? And then, like, they're stellar businesses, right? They're gigantic. They throw off so much money. There's so little money invested in them. And they're growing at just astronomical rates, even now. Like, Microsoft's return on equity is something like 40%. It's just absurd.
Yeah.
And return on invested capital is, like, just incalculable.
The last time I looked at AWS, they were growing at like 30+% and doing unlevered returns on equity of so returns on capital, right? Of like 28, 29%. It's basically like a real estate business kind of, right? It's not like it's got capital in it. That's crazy. At size.
That's absolutely absurd.
That's like the next iteration of infrastructure. So I get why that has a huge multiple to it. Like, I do get that. But that is a way different discussion than, like, some of these small SaaS companies that are still emergent and maybe are going to have to attack each other and stuff like that. Like, doesn't make sense to me.
Do you think that you almost have to throw away those old rules? Like, we quote them on the other podcast a little bit where we talk about, these are the rules of thumb for, um, a company. Like, how long can a company with like revenues over $50 billion sustain a 25% growth rate? What's the chance they do it out for a decade? And you get to the number and it's like, it's vanishingly small. It's like 1.7% or something like that. So
Yeah.
it has happened. But like, I'm not even talking about grossing these up for inflation. I'm just like, have we just entered into this new world now where these gigantic companies, because it costs them nothing to grow, and the thing is like they deliver this exact same product to 7 billion people on the face of the planet Earth.
Yeah, but dude, here's the thing. I know that everybody says that it doesn't cost them anything to grow. The problem is a lot of these companies that everybody's saying are like so great have SG&A lines greater than like their gross profit. And I understand that there's this argument to be made like you're land and expand and let's get in and it's recurring revenue. But to me, that kind of feels like the person that has to continue to invest in machinery in order to keep their business going.
Well, that's a good point.
Now, I do think that like the way that the income statement works, right? You got the spend on SG&A before you're realizing the benefits. And with SaaS, you're not selling like a lump sum. So you got to build into the cohort analysis. Like I get that. But man, they're spending a lot on SG&A. And if your sales team leaves, like look, Salesforce just had to buy Slack.
Dude,
And
that was a wild one.
one of the reasons that's being cited is like, when you're playing an enterprise game, you need distribution. So like that sort of is saying Slack didn't win because their Salesforce doesn't have the muscle that Salesforce has. If that's what you're going to start to bat up against, then like all these enterprise SaaS companies seem, I don't know, to have a downside skew to me.
Are you saying Slack didn't have the enterprise?
That's what I've read. I mean, I don't really know, right? But I'm just telling you, like, what my fear in that industry is you're always going to have to SG&A becomes your machinery.
Yeah. But
I think Slack didn't have I think they lacked the distribution. Yes. So so Salesforce thinks they can buy Slack and plug it into their offering and maybe compete against Microsoft as a bundle.
How many people do you know who use Teams?
I don't know. I've heard very mixed things about Teams.
It's the weirdest thing. Like I had to log into it to do some podcast somewhere. It was a nightmare to log into. It was a nightmare to get connected to these guys. And Slack is just so easy to use. I can't believe there's anybody out there using Teams. That's going to get a whole lot of hate mail.
No, I mean, the reason is because it's everywhere, right? I mean, that's the whole... They almost don't even have to be good products. One thing that Saurabh Madan said to me, shout out to Saurabh. I'm not trying to drop his name or anything, but
I'll drop it. Hey, Saurabh, how you doing?
Yeah, he's a good dude.
I've never met Saurabh face to face, but Saurabh got me my Google interview. Got my Google.
Dude,
talk.
He's a great guy. My buddy Rishi out there is a great guy too. They
Rishi.
got good people.
As far as I'm aware, there's only two people. Well, Saurabh doesn't work there anymore, but the only two people I've ever met from that's not true. I've met quite a few people there, but who I've interacted with a lot of Rishi and Saurabh, and they're the only people I've encountered outside of that world. That's funny, isn't it?
Yeah.
That's everybody who works at Google? It's like two guys,
I think there's more. No, I met their value invest, like a group out there. It was really nice. I think I'm allowed to say that. If I'm not, I'm sorry, folks. Anyway,
I don't think it's a state secret.
No, I don't think so either. I did have pictures on Twitter.
Were you not allowed to have those?
No, I was. What the hell were we talking about?
Who knows? We were in the third inning of the melt up.
We're gonna have to cut
that problem.
Yeah. No, I don't know. It's an interesting time right now. I do think that in general, my perception of value was too naive when I came into this game. And
mine too. I think everybody's that way.
Yeah, I have been able to expand my mind, and I'm actually honestly really thankful to FinTwit for it. I mean, as much like silliness goes on there, there are some accounts that have really made me smarter, and I hope I reciprocate in some way.
It's it is amazing the stuff that people share on there.
Yeah.
Honestly, I'm just astonished at some of the ideas that I've seen go through that are just absolute blockbusters. And then I find that then I find it odd that there are people on there who complain about it. Like I'm just like, are you are you not like paying attention to what's happening on this thing? This the return for time spent on it is astronomical.
Yeah.
If you're just on there complaining about stuff, I honestly don't get it. Like, get off, go and do something else. Like, I don't get it.
I mean, the thing is, man, something that I think is interesting about it is you're forced to confront, like, my perception of a Momo bro is really just a different way of looking at the world, right? And there's something about like our two ways of viewing the world that clash. But what I've been able to do is open my mind to like why they see it that way instead of just being like they're wrong. And that has enabled me to adopt some of what they are correct on. And I think that's made me a decent amount of money.
Yeah, that's a good way of thinking about it. I do think there are some guys out there who are doing real value, like Elliot Turner, who I just talked to about Twitter and PayPal. Like, I love the way he thinks about businesses. I love the way he thinks about investment. Like that to me is the pinnacle of investment. If you're thinking on those levels where you understand the business so well that you can see what's coming through the financial statements, not needing to see it in the financial statements first. You know, that's what gets you to that Buffett level where you're seeing through the matrix, you're seeing the numbers falling from the sky, you know?
Yeah. No, I mean, I think it happens when you can really understand a business and what the strategy is in the business and who they're competing with. I mean, like, I haven't opened up Charter in a couple months, and like, I really don't need to. Like, I think I know what's going to happen next quarter.
You've worked out the few things that matter, two or three factors.
Yeah, but it's not me, right? It's like who I interact with. It's because I get to talk to Alex and Francisco all the time. It's like where we spend our time.
It's still the same thing. The reason it's the same thing is it's not your idea until you internalize it. And it doesn't matter where it comes from. Once you understand it's irrelevant where it came from.
Yeah,
if you act on it without understanding it, then you're an idiot. But if you, like, I think about that all the time. Like, where do any ideas come from? You've clearly got it from someone else at some point.
Yeah.
So you've internalized it. Now it's yours.
Yeah, that's fair.
That's probably not intellectual property advice, but
no,
like in terms of having ideas.
Yeah. Well, and you know what I have is I have the conviction to hold through a bad period, and I know what I'm looking for to bail, right? So I'm no longer like looking to the market to see if I'm correct. It's like, okay, I know when I'll be wrong, and I don't really care what everybody else says, and that's when it's yours.
You're an industrialist, mate.
Oh man, just trying to survive.
That's it. But I think that's right. Like, that's the point, that's the thing that separates you from sort of being a stock market operator guy.
Yeah.
And being like an industrialist investor. And I don't want to be a stock market operator guy. I want to be the industrialist side. So I want to spend all of my time thinking about, the qualitative elements that, like, there is something to understanding the mechanics of that. They're really, even though it's not necessarily quantifiable.
Yeah.
There is some sort of logic to it that it should then lead you to the point where you can make better investment decisions understanding that stuff.
Yeah, no doubt. And like, it's helped me. I don't know that I would know how to size things if I didn't understand quality. I don't know that I would be able to like be I wouldn't understand. I know everybody's got to hear about it, but it's true. Like, curate's my last good idea, but like, I wouldn't understand like why the debt is structured the way it is unless I understood the consumer and I understood how often she purchases. And like, you just got to understand the business to understand the cap structure, because
it's one of those great opportunities where you can understand the business is understandable, but also the sort of incentives of the manage, like the Malone Liberty structure that sits behind it. You know that those guys, like, that they know what they're doing. Doesn't necessarily mean that it'll work out perfectly, but you know that they're going to structure it in the right way to maximize your return as a shareholder. It's not going to leak away somewhere else.
Yeah, and something else that I think that I've learned from just absorbing things, right, is like when I came into this, Buffett was like, no debt. right? Well, that you can pray to that church, or you can say to yourself, why does John Malone have this much debt on this entity, and try to solve that question. Or like, why can TransDigm carry this debt, and why can Charter? And all of a sudden, the way that screens show up starts to change.
Yeah.
And I like that. That's probably why I see a little bit more value in levered situations, because I take a debt first approach to that stuff. And I don't think the equity market does too often.
No, 100%. I agree with that. Yeah. I just don't trust myself enough to understand not like the meta game in debt. I understand. I can read the doc, and I can understand the levels of debt and all that sort of stuff. It's the kind of the incentives of the players behind who can trigger. Like, I've just never been in that world. I don't know how anybody thinks when they're like working out where they're going to collapse on your debt and collect. Like, that's the part that just makes me nervous. Like, because I know a lot of business guys who, it's not unethical, but they're aggressive, right? They'll loan money on a convertible basis with the idea that if the team running it stumbles, they'll get control of it.
Yeah.
Like, that's what their objective is. And it makes me nervous that sometimes you're on the other side of the table from that guy. Now, Malone probably not ever going to be on the wrong side of that table. So you're just backing that horse.
Well, who do I partner with? Like 3G, who's not going to be on the wrong side of that table. Malone, who's not going to be on the wrong side of that table. I don't think you can do it with an average management team. I think that's suicide.
All right. Well, that makes sense. So that's how you're thinking about it. Yeah, that works. That's a smart way of doing it.
Because like with 3G and AB InBev, first of all, that business can handle debt. And that probably wasn't the best pick I could have figured out. But a lot of my thesis was like, you can't, when you're dealing with 3G, you can't actually just pull some credit from AB InBev and expect it not to impact your Kraft Heinz relationship and your QSR relationship. So you're really, as a banker, you're pitching the entirety of 3G, and you're going to support the business that needs support if you care about your bonus.
Yeah.
It's a different debt level game. Like, those guys aren't playing by the exact same rules.
Yeah. That's what I'm talking about. Understanding that metagame. So that's good. That helps me. Okay.
And that's like how I see Netflix too, right? Like, they're just playing by different rules. So I think that understanding like the players and how they think helps the valuation stuff in that game.
100%. 100%.
And I think if you don't understand it, it's a super easy pass on a lot of those things. And there's opportunity there.
Yeah, that's interesting. I do think there's a lot more to understanding. You know, I don't think that, like, when I think about what Buffett does, like, I don't think Buffett's not playing a valuation game. He's playing this meta game all the time. Like, we can see the things that he selects out of the cheap bucket. You don't really have the other dimension where you're seeing why you can figure it out. I'm not saying you don't have it, but like, he's clearly been playing that game for a lot longer, where he's got this industrialist approach to the world, where he's going to build out this sort of impenetrable moat around himself in all of these different directions. And he looks for the same qualities and the stuff that he's going to buy, and he's just not going to execute. And so his game is it's not a valuation game. It's this meta power game, if you like. And that's how he gets the great deals from, you know, when Goldman Sachs, he gets the gigantic 9% pref from Goldman. Like, that's just amazing to think about, you know?
Yeah.
Because they needed his reputation as much as he wanted to give them, like, because they needed the money, you know?
Yeah, I do know. And like, the thing that's cool, you know, is if you were my perception of a guy like Gavin Baker, like, he's playing that game in that cool industry. Like, I wish I had that skill set. I don't have that skill set though. I'd like to build it up over time. Right?
You got it in one part. You got it in debt.
Yeah, that's right. So that's where I play sometimes.
You just apply the same rules, right? You just figure it out and build out slowly into different adjacent areas until you've covered the lot. That's the only thing you can do.
Yeah. Also, I gotta like mention, I'm super fortunate to be able to talk to like Skelecap and stuff when I need like help, right? I mean, and that's where the community of Twitter has come in to be like, dude, I know that you're on in it. Like when I was looking to curate, I had a sense of the debt package and I had a sense of how to like analyze it, but I needed a debt expert to be like, no, dude, you're not missing anything, right? And I've built up a relationship with him over time, and it was really nice to be able to rely on that guy.
Yeah, that's cool. It's one of the powerful things about it. Dude, you've done well to kind of like network in to figure out who all these guys are. I mean, that's part of the game, right?
Yeah. Well, and I try to reciprocate, right? So, but yeah, it's been fun. It's a bunch of cool guys. Like the good guys on Twitter, they're really smart and they're really fun and it's nice. It's amazing that it exists.
Yeah. Like you couldn't recreate it geographically. Like if you think about what it would have taken, like even 15 or 20 years ago, you basically had to go to New York. You had to be on Wall Street. Like you had to figure out and work your way into it like that. Just think how hard that is to do. For one thing, you got to be geographically there. Like that's hard. Figuring out who they are and breaking into that circle, that's hard. That's impossible. Now, like Twitter facilitates that. You can be anybody. You can be some 22-year-old kid who's figured out something super smart. You know how to do it. And there are guys out there who definitely do, who've like internalized all that Buffett stuff, like taken it to a different level. And you all of a sudden, like if you share those ideas and people like them, you can connect with those people and they'll reciprocate and your learning is just astronomically more rapid than it could be in any other place. And you've got these kind of connections on a merit basis where, maybe you go and work in their hedge fund, maybe they seed you. Like it's a phenomenal tool. It's kind of amazing.
Yeah. And there's no barrier to entry, right? I mean, the barrier to entry is, are you going to be thoughtful and add something to this
Yeah.
discussion, or are you going to be a dick? You
That's
know,
it's crazy, right?
yes.
Why would you squander that?
I have no idea. Like, look at what it's done for me. I had a really important moment in my personal life, and 7,000 people that were there to not only solve it, but also apply pressure on Robinhood to get change. Like, that's
Yeah.
incredible. And that only existed because I've approached Twitter with like a give first mentality for a while.
Yeah.
And then, I'm able to sit here and bullshit with you because of it. And
Yeah.
it's been great. It's
Well,
amazing to me that they don't capture any of this value.
to be
Thank you, Jack.
they got to figure it out. They'll figure it out. I think they figured it out. I think they figured out how to do it. But dude, we met at Berkshire.
Yeah, I know.
We met the old fashioned way. Like this is the crazy thing, right? Like, but then we couldn't, like, without all these tools that we wouldn't
We wouldn't
continue
have
on
been
with
in
this.
touch though, probably, right? And then you probably wouldn't have invited me on Value After Hours or to do your podcast. Like I wouldn't have been on the
Yeah.
top of your head, and then nobody would be listening to this. I'd be just like talking to the middle of nowhere.
We connected. Yeah, we connected through Twitter. Was that the other way we sort of
No,
stayed
no,
connected?
we met at Berkshire.
I remember that.
Yeah, and then like
How did we stay in touch?
I think it was Twitter.
Was it Twitter? Yeah.
I think so.
Oh,
Yeah,
that's powerful, dude. That's crazy.
I know. That was a fun night that we met. I
that
crushed
was
wine
fun.
on that rooftop.
I don't remember.
And then we
much
met
of it.
up with your
It was too fun.
we met up with your Australian friends.
Oh my god. Yeah, those boys get off the leash when
I know,
they're
man.
away.
You were like, I think it was like 11 o'clock, and you were like, you want to go meet some Australian friends of mine? And I knew what I was getting into,
That's
and I
danger, Will
said
Robinson.
yes.
There are a few photos of me from that night, and I'm like, in all the photos, I'm like surprisingly sober relative to what's going on around me. And I know I wasn't at the time, but like it's kind of astonishing that got, and that was like, yeah, it was wild, but it's nowhere near the wildest thing I've ever been. Like they were reasonably well behaved.
Oh yeah, but that's what's so fun about that weekend. Like it's
The networking is amazing.
it really is, man.
You got to hang around for the night when Jake and his business partner go to dinner at Gorat's, and like they time it to go in there with Buffett and Munger.
Yeah.
And then you got to make sure you don't order the Buffett steak because it's garbage. Sorry, Warren, you're good at a lot of stuff, but you ordered the wrong steak.
Yeah. Doesn't he like it well done or something?
Oh, I don't know, but the only way to have them is like the outside charred to hell and like a big crust on it, and the inside still a little bit pink. Like that's the only way. If you're not eating your steak that way, you're doing it wrong. I'm sorry. I come from a beef cattle. Like I grew up in this little country town in the middle of nowhere. It's like a beef cattle area, biggest sale yards in the southern hemisphere. All this sort of bullshit. I was like a steward at the local show. Like you have this like these exhibition shows where people show off their gigantic cows and stuff like that. It's very kind of foreign to me now, but it's like basically I would be the one leading the cow around the like the oval so they could show it to the judges and all the crowd there clapping. Like then they'd pin some big blue award on the winning cow. Dude, it sounds very strange as I'm explaining it to you now.
So how do you end up writing investing books? Well, you went to be an attorney. Why'd you go be an attorney?
Because in my town, there was like, you could be a doctor. If you're a professional, like if you were smart, you could be a doctor, you could be an accountant, or you could be a lawyer. I think that was kind of the three jobs that I saw people doing.
Hmm.
And I was like, I don't like blood. And this was like, I was knocking the horns off. I was like they call it a jackaroo. You go and work out on a property that's like a working cattle property and you get paid for it. And one of the things that they do is they bring in the bush mob who are all these pole Herefords. They got these big horns on their head and you got to knock the horns off, brand them, castrate them, ring bang them, which is basically take a ring of
No
the
wonder you
hair
don't
they've got on
mind
their
taking the
tail.
pain of being a value investor.
Right. Like there's just so much blood in that. You can't at the start of the day, I was like shocked when you knock the horns off the cow. It's like spraying blood out the top of its head. Dude, it was
This is a
shocking.
family podcast.
By the end of the day, you don't even notice that it's going on. But like I did it year after year, and it kind of sickened me. I still love steak. I'm still going to eat steak, but it did kind of sicken me a little bit, like the gore of it. Um, so I didn't want to be a doctor, basically, and I thought that accounting was really boring, which is weird because that's like basically what I do now. So I was like, law looks like fun. You get to go to court. And a little country town where I came from had this like famous courthouse so I like this story. So that Australians have bushrangers. So a bushranger was like, I think in like the late 1800s, early 1900s, they were basically these outlaws who would roam the the highways. They're basically highwaymen, and they would just like stop stagecoaches and rob stagecoaches. And they got this like, Australians like underdogs and criminals and like those kind of stories. And so these guys were like kind of folk heroes of the day. And so there are all of these songs about these guys, like the Wild Colonial Boy and Ned Kelly. So they always make movies about Ned Kelly because Ned Kelly wore armor.
Okay.
When he robbed these things, so like they'd shoot him and it just like hit his armor. He was like Iron Man. And basically they figured out you just got to shoot him in the leg. And so someone shot him in the leg and he fell over and they hung him at this place. But basically the little town.
This is the weirdest investing story I've ever heard. I know it's not investing, but on an investment podcast.
Anybody who's hanging on to this point, mate, just gets all the weird stories now. So in this little country town where I grew up, they had this courthouse, and I've got a painting of this courthouse that I keep now, done by a local artist, John Morrison, who paints in watercolors. But they basically, there was this guy, his name was Captain Lightning. So everybody got a cool nickname. So that was part of being a bushranger. You're the Wild Colonial Boy, or this guy Captain Lightning. So what happened was he was a ringer he was working on a big cattle property in like 18. I need to go and look it up. It was like I think in the 1800s, and that it was like all the properties out there are huge. So basically, what this guy was doing was he got a whole lot of cattle. Like he just pick them off one by one, and he took them into a holding pen because it took him, a long time, like weeks to do this, to round all these cattle up. And then he drove them from like Roma, which is like just on the edge of like one of the driest deserts in the world. He drove it through this dry desert, some astronomical distance, like 2,000 miles, something like that. There's no water. Like it's kind of heroic to have got this thing to Adelaide, where he's then sold all of these cattle. And then he heads to Sydney as like a gentleman, as like a wealthy gentleman, because he's now got all of this money. So they get these Aboriginal trackers from Roma, and they track them across the Nullarbor Plain, and they figure out where they drove these cattle to. So droving is like when you get the big herd and you just like guys on horses, like keeping them all together over a really long distance. So these Aboriginal trackers track them to Adelaide. Like that's an astronomical feat in and of itself. And they find some guy who they'd sold this big white bull. Like they changed all the branding. So like they didn't look like they'd been stolen, but they sold this very distinctive white bull. And they figured out that it was him who sold it. And then they tracked this guy who changed his identity to become like this wealthy gentleman. They tracked him to Sydney and they arrested him. and they brought him back to Roma for trial, where if you're convicted of cattle rustling, they hang you.
Wow.
They tie up the white bull, like they bring the white bull back from Adelaide, they tie it up outside the courthouse. So they're inside, they give this guy the trial. At the end, they give and this is reported in the paper, they don't actually report this exchange, like this little exchange is like folklore from my little country town, but the rest of this is recorded in the paper as it happened. So they ask the jury, like, what do you, guilty or innocent? And they say, he's innocent, but not guilty, but he has to give the cattle back. And the judge says, well, that's an unsafe decision, right? That's not a real decision. You have to go back and reconsider your decision. You have to give us, like what you've said there is he's fulfilled the elements of the crime, but he's not guilty. If you find that he has fulfilled the elements of the crime, he's guilty. Go back and reconsider your facts. So they go back and they reconsider, and they come back out and they say, Your Honor, he's not guilty and he can keep the cattle.
Wow.
So they just say it's an unsafe trial. He gets off, and so it was like locals didn't want to see a local guy get hanged, basically.
Yeah.
And so they decided that the courthouse was basically like just a lunatic asylum, and they banned them from holding any cases there for like a really, really long period of time. And so finally, like they'd reintroduced it like late, like inside the last 100 years, they reintroduced this hearing court cases there. So it sort of sounded like that'd be fun, like going to court. There are all these cool stories. The lawyers are actually kind of men about town, kind of doing stuff, and it just looked like fun. So I was like, I'll try law. And then it turns out, and then, once you get into law school, I got a little bit smarter about like, some guys there had dads who were lawyers who were in the city, and they were like, don't go back to a little country town to be like a local solicitor doing property conveyance because you'll bore you silly.
Yeah.
Like go and do mergers and acquisitions in the city. And I was like, what's that? And they kind of explained it to me, and I was like, oh, that does sound like fun. So then I kind of worked into a big firm, and then the big firm transferred me to the States. And all through that period, I was kind of reading my Buffett, and I was trying to get to that level. Like that's kind of the trajectory.
So when did you start writing Concentrated Investing?
That was 2016. When did I start? Like 2015, something. So it could have been.
So that was okay. So you did quantitative value first, right? And that was what, 2012-ish?
That was with Wes. Yeah, that was like I think it came out right at the end of 2012.
That makes sense. And then how long did it take you to do deep value?
I turned deep value almost immediately. There was a little delay in it coming out, but I think it came out like August 2014, and I think that it had been December 2012. So it was like, it wasn't much. It was like, is that 20 months or something in between? No, less than that. Whatever it was like 18 or 19 months between them. But I had like deep value just came out like in one go. I kind of feel like
what?
Yes, buddy. I'm doing something, amigo. Sorry, dude.
It's all good.
What were we talking about then?
Deep value. You sat down and you wrote deep value in like one go? I mean, not one go, but like quickly?
It was like, it was ridiculously fast. It was like 3 months. It was something like that.
That's crazy.
But then it's like this, I've been thinking about I had the idea for so long. Like I wanted to write the book for so long. It's kind of like if you give it that long, it sort of writes itself in your mind. It's the same thing with this one I'm writing now. Like I've been trying to do it. I think I've been trying to do something like it for about a decade. And I've like partnered with 2 guys to help write it, and they've both fallen through. And it's almost like, because I just wanted to get the idea down, but I didn't have the time to do it. And now I've finally got enough time that I can start writing again for this thing. Like I feel the same way when I was writing Deep Value. Like I think that there's this single strong insight in it that I find fucking game changing for me. Like if I want to apply these things in my life, so I'm 100% sure it's going to resonate. That sounds very confident, but I feel like it's going to resonate with people who, maybe not a lot of people, because I think you need to have spent a little bit of time in value, and you really need to have been converted to that more Buffett style of value or the game that they're playing. But I think that within that small community, it should resonate with those guys. So I feel good about it.
I don't know, man. I think people are going to be interested in reading a book like that from you. I mean, as long as it's good, I think,
Yeah.
you're going to have, there's a lot of interest in like people that are morphing to quality. I mean, I think that that's an interesting transition. Not that you're not that you're abandoning value or anything like that, but the stuff that you are talking about integrating is not the stuff that you've talked about in the past. It's
See,
different.
I don't think that. Yeah, it's true. It's definitely a different way of thinking. I don't dispute that at all. But I
It's
don't
not
think that.
inconsistent. That's not what I mean to imply.
And no, I don't think it is either.
Yeah.
But that I just don't think that's quality so much. Like it's a quality. It's not even quality. Like quality is kind of like, of course there's going to be. Of course it's got to be undervalued, and of course there's got to be quality. And like those two things are just like givens that to do this. But it's more than that. It's like there's this. There are these other. There are three factors, right? There are only three factors. Is the business impregnable? Is the business inevitable? Like, is it one of those businesses that is just that strong? Is the management team one who understands investing? Like, is it a management team like the Heiko
Yeah.
guys? Is it a Buffett? Is it a Malone? Is it like, I don't mean someone who is quite good. I mean someone who is an absolute stud in that area, who you just know is going to do a good job. And so that like culls a lot of people, because like I think half the firms out there are just, like actively fucking over their shareholders.
Yeah.
I think there's a lot of them, like they're just, the money that the compensation scheme is just too big. They're selling shares into the market every day. They don't care about the business. They don't care about the people who are in business with them. And I don't want to be in business with someone like that. So that's kind of what I think, that if you start thinking about like, how do you ruin yourself in this business? And how do you make yourself invincible? How do you make yourself fragile? How do you make yourself stronger? Like that's the only two things that I'm thinking about. Like, does buying this thing make the sort of the thing that you're running, the enterprise, yourself, like whatever the vehicle is that you're buying it in, does it make it stronger? Does it move it towards invincibility? Does it introduce harmony and variety and all these other qualities that you need? It's not a departure from value at all. Like it is part of value, but it requires all of these other components too. Otherwise, you just don't do them. And the reason that you want them is that you want, like, but I use Berkshire as like, I sound like I'm obsessed, and I guess I am a little bit obsessed, but like I use Berkshire as the example of like that's the exemplar, that's the pinnacle of what you can get to. So everything else you're like handicapping on some like that you're never going to get as good a capital allocator as Buffett.
No,
but
I mean, Amazon people would argue, right? But we'll see. But I don't disagree with you. I think from an investor's standpoint, Berkshire is a pretty good shrine.
That's a fair point, and I do think Bezos is in that category of people who I'd have just described, and I would say Amazon is in that category of like business level quality.
They're industrialists, right? Like Bezos, what he's building requires industry, and it's a different skill. And to be able to pull that off in a capital light manner in a different way that Buffett did, like that's pretty freaking impressive.
That's kind of what I'm looking for. And that's like the name of the book is Invincible Industrialist. That's kind of what I'm thinking. That may change, may not have either of those two things in by the time it comes out, but that's kind of what I'm feeling at the moment.
Yeah.
Because I kind of think that's what Buffett is. Like, he's this invincible industrialist. I don't mean like literally invincible. I know that I'll probably get COVID and die tomorrow. Like that. I'm not talking about that necessarily.
No, you're saying his business has been set up that it can
Yes.
weather any storm.
Yes. But but also part of that is like you have to be, one of the parties who you're dealing with is the government. Like, you have to have good regulatory relations too. It can't be something like, as much as I love, like I think that there's something amazing about Uber too. But Uber does run this risk that they're actively ignoring regulations in many places.
Yeah, Uber's got, I think, I don't know, that's got some risk attached to it in many different ways.
100% agree, but I think that if you think about that business, though, that is a phenomenal business that can't be replicated.
For sure.
They just need to there's some harmony issues there. There's like harmony issues with the drivers, harmony issues with regulators in California and other places. And, that they don't run the business necessarily. Like, if there was one industrialist in there who owned like 40% of it, I don't think they'd be issuing stock the way they do.
I don't know enough to really know if this is true, but I've also heard like their culture is super cutthroat. That said, so's Amazon's, and it works for them. So,
Is
it's a
Amazon's
matter.
cutthroat? I've never
Oh
heard
yeah,
it
man.
cutthroat.
Oh yeah.
Okay.
I've heard stories of Bezos just like skewering people in front of an auditorium of other people.
Okay. Okay.
There's a lot of accountability there. And I don't know if it's healthy, but you know what? It works. So what are you going to say?
Buffett doesn't do it.
Yeah, he might outsource that.
Like I keep on thinking like that you can sort of simplify your life just by deciding there are things that you won't like. There are just categories of things that you won't do. As an investor, I'm talking about like you just and probably like in your life as well. But if you like you have to be. I don't even know if I have the discipline to do it, but I just sort of think that you can exercise this kind of monk-like discipline, which is what I think Buffett does. He's got this monk-like discipline where he just does not, he won't take on anything that has any of that risk attached to it. And I think if you can get to that level, where you're batting like that, then I think you can create a portfolio over time that has those qualities in it. I think it's incredibly difficult to do it. Like I always used to say, the guy I used to work for, Troy Harry, shout out to Troy. I know he doesn't listen to this stuff.
He might.
Yeah, now he might. But like the thing that he did, like he had this, he had a simpler investment strategy than what Buffett was doing because he's sort of looking more at undervalued assets where there can be a catalyst and he can introduce the catalyst. But he's still got this same kind of, when I look at the guys who I know who've been very successful, like investing their own money in the market, who've like really compounded at an astronomical rate to make themselves like, individually wealthy as a result of doing that. They do all seem to have this sort of, well, there are lots of guys who've like lucky in options too, so I should be careful about this. But
yeah, but you're talking about the investors that you really
the ones
respect.
the ones who I respect, that's exactly right. They do have this like monk-like ability to just ignore almost everything except for something that fits their profile perfectly. That's how you become great. You like everybody is seeing those pictures and recognizing them for what they are. But the guys who are great only hit those things.
Adam Robinson said this in a different way on a Tim Ferriss podcast. He said that in his opinion, the guys that are really great, they like have one specific nail that they're looking for.
Yeah.
Right. So they
exactly
don't necessarily carry a hammer and try to hit every nail. They are looking for the nail.
I think that that's what I would like to do in a discretionary vehicle. So that's what I'm trying to get to, that kind of point. But I think it's an incredibly difficult thing to do.
It's really hard to watch stuff happen around you.
Yeah, 100%.
And to just be like, okay, I'm not doing anything. Like that is a real skill.
You have to like, this is the thing that I like about value. Like value investors have a code, right? Like you have these rules of conduct in the way that you manage your portfolio. And, as you get closer to Buffett, like you have these rules of conduct about the way you engage with the world as well. Like Buffett has done incredibly well to like create this harmony in the world. Like he's elevated what he does. He's not a rapacious capitalist industrialist the way kind of the lead industrialist of every other generation has been. Because he recognizes that invites like, do you want an Ida Tarbell? So John D. Rockefeller got taken down in this famous book by Ida Tarbell. It kind of ruined his reputation and introduced all the antitrust legislation. Like she basically took him down because he was the great robber baron of his day. And it's been true of all of these guys over the years have had to face some kind of attack. I just don't think Buffett's like just understood those lessons and just said, don't just bring harmony. Don't invite those attacks. So when you read his letters, like he's just telling everybody what he does, without telling them about that third dimension that you can't understand anyway. Yeah. He's just telling them about the value part.
The other thing
even early on, like when he liquidates the first business, and he's like, holy shit, you don't want to do that. Don't liquidate. And so then he starts, he writes about the sort of slow liquidation of Berkshire, like the spinning mills, that part of the business. And he's like, it wouldn't have satisfied Karl Marx or Adam Smith. So he's already thinking in that, like, you got this risk from, like, revolution is a risk. It happens all the time around the world. And he's thinking in those terms. He's like, nuclear weapons are a risk. He's just, all he does, his radar is just all risk and look for that singular pitch.
Yeah, I think that's right. I think that's why Munger has said that they're willing to pay a much higher price than most people are for a quality business. And the way that I reconcile that with inaction is their definition of what that business is and what is bankable and underwritable is so much lower than everybody else's that, like, yes, yeah,
But even having said that, like Buffett doesn't swing until it gets quantitatively cheap.
yeah,
I mean, you got to, like, Apple sat there for a long time and then it kind of swooned and then he just bombed it.
yeah.
I mean, you think about the kind of monk-like discipline that takes to just sit there for a decade basically doing nothing,
I know. Think
waiting
about
for that pitch.
dude. Look at the cash he's sitting on right now. Like, you think he's looking at everybody? Like, I mean, he's got to be going a little bit nuts inside, but he's not because he's Zen, you know. But
he's got that monk-like. So, dude, this is the the final part of my book is this part on Stoicism because it is like it's incredibly helpful. And the Stoics and the Zen guys are very similar. They've got very similar approaches to the world. The only difference is I think that Stoicism is a little bit more practical because it doesn't require this, like, Zen requires some meditation. The Stoics are like, just think about it as you're going to sleep. Like they're much more kind of like day-to-day practical, and their objective is like be kind of unperturbed by what's going on around you. Like, and I think that that's the mindset that you need to become invincible in the stock market. Like, you need to start thinking. You just FOMO. It's not that you're like above it. It's like you don't even realize, you don't recognize it because you don't feel it because you're looking for you're trying to hit your nail, as you say. You're just looking for that nail, and like you can't hear anything else going on around you. You're just sitting there waiting patiently for your nail.
yeah, I've gotten closer to it. I got a long way to go.
We all do. Like I'm just like, I want to write the book in some ways to hold myself publicly accountable.
Yeah,
Because like I want it to be out there, and then I want people to say, well, what does this guy think is like, what is his version of this, and then to go and look at what the thing holds, and say, well, that doesn't meet the criteria that that would be awful if that was to happen, right? So you kind of like, I want to build in as much of this, as many of these like psychological, behavioral ties, so I can't go back on it. So that just like anytime I do anything, it would just be embarrassing for it to not meet this criteria if somebody could like just point out the fact that you'd missed.
What does your current structure do to preclude you from making that? Like, does it preclude you? Does it make the transition harder? Like, you know what I mean?
I don't think so, in the sense that I still, I don't think that you can do one thing to the, just to sort of move away from what I've just said. There is I do think that the long-term returns, that more deep value quantitative style, are going to be the better ones over the very long term. Because I don't think you're so much doing the second thing as a purely return. It's like a risk return thing, in the sense that what you're aiming for is no risk. And then any return that you can generate above that is like, that's alpha. That's free return, the way that I think about it. Like risk-free return, if that makes sense. Not that that's...
I understand what you're saying.
None of this is investment advice, but I'm just saying, like, that's the object. That's what mentally, that's what you're trying to create.
You're trying to wait for a situation that the downside is so low that your perception is that it's riskless, and then you're trying to bet it. So any return over accepting that risk,
that's it,
is risk-free to you. Whether or not it is in reality is a different story.
Right. But I still think that extreme level of choosiness will generate, that will be a portfolio that will just grow and compound over a very long period of time. But I do think that you can take a little bit more risk at a deep value kind of level and generate returns that justify the additional risk that you're taking there. I do think that you're going to get higher returns. I think they're going to be more cyclical, because I would have said that I think that the invincible one will be less cyclical because you're always trying to price the growth appropriately. I think that the value one sometimes misprices growth, but for the most part, it does a pretty good job of just not making mistakes. it's not going to buy the wrong it's not going to blow itself up, you know. It's
Yeah.
not going to buy the wrong thing. It's going to be uh, it should generate reasonable returns for the risk that it takes. It's just that the other thing's trying to generate returns for no risk.
Yeah, that makes sense. And your ETF can just run itself, right? It doesn't
Right.
require active, so you can focus on both.
There's a lot of bullshit in the back. There's a lot of compliance and like work in there's a little bit more than that. But it doesn't require anything like it would there's lots of free time to do other stuff.
Yeah. How'd you think of the podcast tomorrow? I guess there were podcasts, right? But how'd you think of Value After Hours?
What did I see for that? I don't know. I was going through this period of time where I was like really enjoying. I was watching Rogan on YouTube. I was watching all of these podcast guys that I could find on YouTube, and I was like, this is amazing. This is just like Rogan's. Like if you go watch his early ones, he's just sitting in his kitchen.
Yeah.
Like, isn't that crazy how he's basically got a talk show that's the best talk show I've ever heard? Because there's none of this fake bullshit in it. It's just like he gets some dude talk for a long enough time that he actually starts saying what he really thinks.
Yeah.
So, like, that was the first few times that I watched it. I was like, holy shit, this is what this guy actually thinks. This is crazy. Why would you tell anybody what you think? And so then I was just like, the problem that I have with the other podcast is that no matter how casual you make it, everybody's selling something. I'm not going to hang anybody for that because like I'm the biggest sales guy out there. But that's only because I've done this enough times and failed enough times in this that I'm just not going to let this business. Like I just will not let anything fail at all ever. And so if it requires like whatever it requires to get it across the line, I'm going to do that. And I think that there are things like you just got to keep your word, like I love that. Who's the guy who built CNN? Ted Turner. He's got this great line where he's like, early to bed, early to rise, work like hell, advertise.
There you
I was
go.
like, that's my man. That's me.
You are a good marketer, man. You got that game figured out, but you hustle.
Well, here's the thing, right? I am like everybody else. I understand what everybody else wants in this market. Like I kind of, and I have hunted for it myself, and I found it, and I want to tell people about it. Like that's literally what. There's not like it's not. I couldn't sell something that I didn't believe in. Like I
Yeah.
found it first for myself, and I was like, you know what? I'll just tell everybody about this thing because I think it's amazing. I think it's a good insight. It's also the way I feel about this other book. Like I do think that people will read this and think, I don't think that any of it's new at all. Like it's definitely not new. It's definitionally not new. But I do think it's like a new synthesis, or it's a new like it just highlights things that you knew forever. But you just like that's exactly right. That was what I couldn't articulate that, but I have sensed that and known that. Like I have those conversations on the podcast all the time. Like Elliot Turner has some great ones where he says something and I just like I'd never thought about it before, but when he said it, I was like, that's 100% true.
Yeah.
And that's a truth that I didn't know that I needed to hear. Like one of them was he said about eBay owning PayPal, and he said it should have been the other way around. If PayPal owned eBay, and like that would make so much more sense. I was like, that's exactly right. Like PayPal kind of withered within eBay, which was a weird.
Yeah.
But if eBay was like something that PayPal had offered, that kind of makes a lot of sense.
Yeah. I hadn't thought of it that way, but that does make a lot of sense. Yeah, Elliot's a smart dude. I like talking to him.
I got some good insights. And that's kind of what I want to. Like I think I've had this one with this Invincible Industrials thing. I just want to tell that story and I'm kind of interested. Part of it is like I want to hear from other people. Like talking to Elliot, I get that same feeling when I'm talking to Elliot. Like Elliot understands a lot of these things. I'm just talking about Elliot a lot because I just interviewed him this morning, so it's kind of top of mind. But and when I think about conversations that I have with other guys who are kind of who are operating at a really high level, I feel like they're saying exactly what I would think that they would say, having read Sun Tzu and not read any, investment stuff. Do you know what I mean?
Yeah.
Like Boyd's like I kind of feel it's uncanny. Like I just think it's uncanny that the connection between the two thought processes.
Yeah, I think in order to be good at that game, like if you're going to play the quality game, I think you have to get to the point where you can think strategically about assets and what would be in better pieces and stuff like that. Otherwise, it's really hard to.
Do you call that a quality game? See, I think that quality is like part of it. Like it's part of it is value, part of it is quality, but it's this strategic part of it is the part that I am kind of interested in. It's that
Yeah,
metagame part of it that I'm interested in.
I guess that I don't know how to define quality without that. Because I think if you're going to take like a qualitative view on something, that's a component of it.
I think we're both saying the same thing.
Yeah, I think so too. Maybe I'm just using a different term.
When I think quality, I'm thinking more like the factor.
Yeah.
Not that I think that when I think about value, but like the quality factor would just be like, cash on the balance sheet rather than debt. Just all of these like quantitative, the way that like an old value investor would have gone through and calculated the quick ratio, and like they just go through and look for those kind of things. Like, is this a healthy balance sheet? Is this a good business?
And guys like me and like Francisco and Alex, like what we talk about all day is like a lot of it's about like media strategic assets and where should things be and why are certain things here and how would you attack it? Like those are the conversations that we have more often.
But I think that's a third thing that sits by itself. That is that is the most difficult part of the game to understand.
Yeah,
and that is the most rewarding part if you can understand it.
Yeah, I don't know how you can do evaluation without it. Like a really good one.
You can't. I couldn't agree more. But it's like I feel that way about quality and value. Like when someone says something, it's undervalued on whatever measure. Like it's almost irrelevant. Like unless it's undervalued unless the quality is undervalued, it's not worth having a go at it at all. It's kind of the way I think about it. But then I do think that what the quantitative stuff misses is exactly that strategic part.
Yeah.
Which I think is the hardest game to play. And I don't think it'll ever be played by computers. So I think it's a game that is worth learning. And I think it's a game that you get better at as you get older. And you just get more experienced, rather than older.
Yeah, I think you got to turn over a lot of rocks, and like I should probably be better about reading old case studies and stuff like that. But it's a fascinating way to live life more than anything. Like if you can really get interested in that stuff, it changes your entire lens on the world.
Yeah. That's like literally that's what I think I've realized most over the last few years is just that there is this big metagame being played all the time in government and business and the big industrialists out there. And you have to understand how that game is played so you don't get squashed by one of the giants as they're kind of walking around. You got to get better at, working out getting, being on their side, being like pushed ahead by them as well, rather than kind of like just being in a direction that the world's not going. And that's a very, very difficult game to play.
No doubt. That's why
but rewarding if you can figure it out.
Yeah, well, and that's why I'm not like that comfortable playing it without somebody's big track record behind it. Like if you look at my portfolio now, it is literally the top 4 of the top 5 positions are Malone, Buffett, and Nick Howley at TransDigm.
Like, I kind of think that's how you do it. That's literally how it's played.
Well, how else would I do it? Like, I need the guys that know how to play it. That's right.
There's no other way to do it. That's the only way to do it.
Yeah, I think so.
That's literally the only way to do it. You need guys in there who are running it, who are those kind of guys. Like that's kind of what I missed for a little while. When I was thinking about the quality of the management. They're like, assess the quality of management. Like it's not kind of this sliding scale of guys who get it. It's just like they are either those guys or they are not.
Yeah, that's right.
And if they are those guys or someone who is like them, I don't mean to say that there aren't other people out there who are like that. Like there clearly are lots of guys out there.
Diamond,
but if they are,
and Iger,
right. That they're either industrialists or they are not. And if they are not, then you don't want to be there. If they are, then proceed on to the other things that you're going to do, like the valuation questions and the quality questions.
Yeah. Who? Oh man, there was this guy that Real Vision interviewed from Europe, and I love how he only will buy into like family-owned companies.
Oh, dude, it's Tony Deaton.
Yeah, I love his outlook at the world. Like that's really smart. Edelweiss.
He's the other guy
right?
who I think does it. Edelweiss, that's it, exactly right. Yeah. So he's the other guy. He's another guy who I'd put in that boat. I 100% agree.
Yeah, he's among like the investors that I respect the most. Like that guy is a guy that I would want to be.
Yeah, that's it. 100% agree.
Yeah, no doubt.
I think, to be fair though, I'm gonna. Yeah, no, he's definitely trying to run that thing like it's invincible. He's definitely doing that 100%. He's holding some gold and some other things that.
Yeah, I don't care if I would do it the same way, but I respect who that man is as an investor.
I agree 100%.
And that's like what I'm trying to become. So,
yeah. Yes,
all right, dude, man. On that one, I'm gonna have to wrap this up because it's been a while, and I actually have to go get dinner.
That was awesome, dude. That was fun.
I enjoyed it. I hope other people do too. And I'll talk to you soon. Fun. I had a great time.
Yeah, me too. Peace.
All right, see you.